efficiency. You can't look at the daily moves. You should invest for the long term, particularly if you're a retail investor.
Lynn Martin, a spirited conversation in Davos. Good to see her again with Bloomberg as well, of course, holding court at the New York Stock Exchange. No doubt interested in what happens with Mr. Gensler in trading for retail, trading for retail here in the coming months. We welcome all of you on radio and television worldwide, and particularly on the evening on the Pacific Rim. We're going to digress right now from the markets. Futures up 20, Dow futures up 110. I agree with Lisa. It's fragile. I'd note dollar strength this morning. Sterling 121.08. Can't get out of its way. Our definitive coverage of Asia has been led by Stephen Engel. He has had the honor from the span of Hong Kong and Lord Patton to the turmoil of Carrie Lam to see modern Hong Kong change. Stephen Engel sat down with the outgoing Hong Kong Chief Executive, Carrie Lam.
Despite some skepticism and cynicism about Hong Kong's future, I remain very optimistic and confident of Hong Kong's future. And one of the reasons for my confidence and optimism is Hong Kong's unique strengths under one country, two systems. Is Hong Kong's high degree of autonomy to conduct her external affairs, particularly on the international arena. So we have the autonomy to set up our own overseas economic and trade offices. We could enter into bilateral agreements on free trade, avoidance of double taxation, investment protection. So I do want to conclude my term by reinstating the importance of Hong Kong's international connectivity and her status as an international city.
But is the damage already done?
Well, yes and no, because if you look at the past 2 years, that is before the fifth wave hit us, for a period, Hong Kong was ranked the world's #1 in terms of normalcy. That is when other countries and places were imposing the stay-home permits and lockdowns and closed the airport and so on. We were by and large operating normally, okay? But since the fifth wave hit us, and it hit us very hard, particularly in terms of the number of deaths.
We went from 300 deaths
so we
to
have
9,300.
to be extremely cautious. And at the same time, because of the transmissibility of Omicron and the mildness of this virus, then other places are opening up. So by comparison, I'm a person who believes in relativity. So everything is relative. When people are opening up and Hong Kong is still imposing a 7-day designated hotel quarantine, that to a certain extent,
Okay, guys, as you can see, position closed on Bitcoin. We closed, we made profit £500. Well done, all of you guys who followed my trade. Let's move on. Let's see what other opportunities will bring us today. If you want to get the strategy, you need to go to companyeye.co.uk. You can get the strategy. You can register for our webinar that I will provide in a few days. Otherwise, stay with me, and I'll speak to you later, guys.
Period from 14 days to 7 days, and then made other adjustments in the test and hold at the airport, facilitating people to come back. So prior to the 1st of April, and for almost 2 years, the daily arrivals at our beautiful Hong Kong International Airport was a few hundreds. Now it's back to 3,000 plus. So I hope that gradually we're able to progress on this route of normalcy.
At this moment of transition, Stephen Engel joins us in Hong Kong. Carrie Lam will pass the baton of Hong Kong leadership, a different Hong Kong, to John Lee. Stephen Engel joins us now. Steve Engel, I'm absolutely fascinated by Carrie Lam as a citizen of Hong Kong, someone whose father worked on ships, she grew up poor, to a guy who was a police officer from day one for the Chinese government, John Lee. How abrupt will the transition be from Lam to Lee?
Well, you could argue from the other side of the coin as well, that could it be any more tumultuous than the last 3 out of the 5 years of her term? Because she, of course, her term coincided with the protests, the national security law, a complete overhaul of the electoral system, and then a pandemic response that was widely criticized for allowing more than 9,000 deaths when they had a couple of years or a year and a half to prepare for that. That was one of her regrets, even though she says she has very few regrets. She did say that she regrets getting more people vaccinated. But you turn the page to John Lee. He's a lifetime police officer and the former head of security. He was her deputy, and he was the only candidate that was endorsed by Beijing to be her successor. And she only served 1 term. Out of all the 4 previous chief executives, not a single one in the past 25 years since the handover from Britain has made it through 2 terms, which they're allowed. It is a difficult job serving 2 masters, Beijing and the people of Hong Kong. She pretty much acknowledged that. John Lee, he has a clean slate. He has a police background. Right. Will it be more of a police state? That's the big question.
Stephen, we've got to get back to the markets, as you well know, but good to catch up and let us not be strangers. Stephen Engel, truly leading all of our reporting in Asia over the decades. Carrie Lam leaves as the leader of Hong Kong. Lisa, we see the shifts on the Pacific Rim. We see the shifts now, and I guess we could center on a Japanese yen of substantial depreciation.
Did you see what they did overnight? That they actually bought a record amount of bonds in order to suppress yields back to that yield curve control. 2.2 trillion yen worth of bonds that they came out and purchased according to the government records that came out. This just shows how hard it's getting for them. And you've got certain hedge funds betting against them and actually trying to short JGBs. But again, that policy divergence is showing up in the ways that it can. And right now what you're seeing is that dollar is reasserting its strength, albeit tepidly, but still we're not getting away from that, Tom, even as people try to come in to buy this dip.
And Kaylee, this is really important in that from the market turmoil of yesterday to today, yes, there's green on the screen, but it's remarkably fragile, isn't it?
It is, and you've already seen that borne out over the last several hours where futures have fallen off the highs of the session. We're kind of just fluctuating here. There doesn't seem to be much conviction, really, Tom, across any asset classes, foreign exchange included. The dollar now fractionally stronger. The yen has been fluctuating since the overnight trade, right around the weakest level since 1998.
Sterling with a 120 handle right at 1.2100 right now, maybe one of the international indicators with Italian paper as well. But to look at the U.S. market, it's simple, Lisa. I looked at the Bloomberg total return indices and bonds yesterday. They had a bad day.
They got hammered. You can say that. They got absolutely hammered, and particularly in the credit space. This is a new trajectory. At what point does the Fed take notice of that? At what point does that kind of create a bottom in some way because they have to respond, Tom?
Is it a cathartic hammering?
There you go.
It was, it was a cathartic hammering. Highly cathartic.
Hey, well, the loss for words as well.
Tom Keene,
Stay
speechless.
with us.
Yeah.
This is
We did
Bloomberg.
it.
Good morning.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must. for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Is convinced the Federal Reserve is going to become more aggressive.
If they're going to do 75, it's better to do it sooner than later.
The Fed doesn't have much reason at this point to slow the pace of rate hikes.
For the next 6 to 12 months, things are going to be much more challenging.
We still think the base case is no recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television. It is a Tuesday before a Fed Wednesday, and it is extraordinary. The market turmoil yesterday, and in some ways different, but continues today. Kaylee Lyons in for John Farrow. Lisa, the character of the market this morning, different than 24 hours ago.
It is. It is more constructive than it was 24 hours ago, where it felt like it was in free fall. But it is fragile. There is a feeling of a lack of conviction and a lack of full understanding of what exactly happened yesterday. We saw a sell-off unlike what we have seen in a long time. Is it capitulation? Is it forced selling? Is it just buyers stepping away? People trying to parse that, but we're watching the end of a low interest rate era in real time.
Lisa, I'm going to call it Tea Leaf Tuesday, getting away from 75 beeps, 100 beeps. Lots of the tea leaves, folks. We have Bloomberg Launchpad. Kaylee Lyons is different than John Farrow's. Lisa's is different than mine. We all have our own red and green blinky Bloomberg. This is why people spend 20-some thousand a year to get a terminal. This kind of flow into us. And I'm looking at my tea leaf this morning, Lisa. Sterling, 120.89. John Farrow may not be able to afford to return from Capri.
Well, we'll see if he decides to, although he is paid in dollars. I just want to let you know that. What I'm watching right now is actually the spread between 30-year and 10-year Treasury yields, which has turned negative yet again for the first time in years. In more than a decade. I find that interesting, this sort of long-term gloom, not to be gloomy, but a long-term feeling that we could not be growing all that much, and this flight to safety in the longer term with such uncertainty in the near term.
In 30-year, that's price up, yield down. worrying about economic growth out there somewhere?
It's a lesser high than 10-year yields, which means that people are expecting growth to be slower over the long term and inflation to be slower over the long term and seek that haven.
Kaylee, what do you see? I want to get to our guest here. What do you see here? And then I'll do a quick data check.
Well, to Lisa's point about those long-term growth concerns, just take a look at the Bank of America Fund Manager survey out this morning. Stagflation fears at the highest going back to 2008. Profit expectations at the lowest since 2008. Global growth expectations at the lowest on record. What does Bank of America call it, Tom? The summer of Volcker.
Summer of Volcker. Claudia Sahm pushing against it, saying this is not a Volcker moment. There are too many differences now from 1979, 1980. One of them, of course, is a bond bear market. A bond bear market is price down, yield up, and we see that with a vengeance. 3.28 on the 2-year yield, 3.29, almost inversion right now on the 10-year yield. Lisa will give you a great perspective on that. The VIX is critical to me, a 30 breach, not to 40, not to catharsis, but 33.48 today with futures up 15. Dollar strength, DXY 105, Bloomberg Dollar Index, a deeper index, confirming that yen 134.32, euro 104.36, and sterling stunning 120.89. We need a brief. Lisa, brief.
8:30 a.m., the latest in a series of data having to do with U.S. inflation. PPI, the prices that factories pay for goods, coming out for the month of May. The expectation is for a reacceleration because of what we saw in the CPI report on Friday. Food prices, energy prices climbing. How does this pass along to margins of companies? They can't pass along the price increases as much as they could before. That is the anecdotal evidence. Do we see this turn into even weaker margins? At 11 a.m., President Biden is going to dovetail the message into the labor market. Speaking at the 29th AFL-CIO Quadrennial Constitutional Convention in Philadelphia, Pennsylvania, how much can he pivot to the strong labor market in the face of $5 a gallon gas? And this is what a lot of people are focused on, really shaping the sentiment of many consumers. And today, the Fed is kicking off that 2-day meeting to discuss interest rates. I'm watching that 2-10s yield spread. How much are we looking at a baked-in scenario of recession that we have to respond to? And at what point does a faster-than-expected tightening cycle actually end up giving the market support because the Fed is trying to get ahead of what we have already seen the market try to do for it?
We do economics, finance, investment, international relations, and politics. And the foundation of this, particularly in investing, has been trading, whether trading is for short-term, trading is for long-term. We're going to change the show right now, and we can do that with Katie Kaminsky, Chief Research Strategist, Alpha Simplex, who's having a killing year shorting the space. Katie, I want to go back to what you've got tattooed to your brain from the CTA crew, which is anti-martingale theory, which is when you're successful, you increase your bets. When you're not, you have your bets. Are you utilizing in your record year of getting shorts right, are you utilizing anti-martingale theory to take bigger short bets?
I'd have to say yes, in the sense that we do really well when things are difficult, when there's dislocations, and when people don't know what to do. And that's exactly what's happening this year. We have complacency, we have denial, and we have fear. That is a perfect scenario where markets can be a little bit more behavioral and less efficient, and thus following the trend is actually a very diligent and less emotional-based way to actually trade such difficult markets.
Are you able, and I'm thinking of the work of Wells Wilder of the late 1970s and looking at something mumbo-jumbo like ADX DMI, does Bitcoin trend? Can you guys take a short on Bitcoin and extend it out here at 22,000 right now?
So I have to admit, I don't trade Bitcoin because I'm a risk manager and there's just a lot of risk there. But what I would say, if you did look at a trend signal in Bitcoin, is that it's definitely gone down quite a bit, but you might need to see a little bit of recovery before we would actually consider that we're having a new trend. I mean, I think that is a very difficult call, but it has significantly reverted from what would have been its previous highs.
Katie, when do you know to close out your shorts?
So we have a process where we're very much about focused on seeing confirmation in data. So if I give you an example, people have just been calling this peak of inflation. We say you can't call a peak until the peak is over. And so I think this is an example. People were too early to call the peak in inflation. We're going to start calling those type of peaks when we actually see that the market confirms that they are going down or that prices are going down.
So Katie, if it's too early to call the peak in inflation, is it too early to call the bottom in the equity market?
Certainly. Unfortunately, that's the case. We need to see more confirmation that we're kind of starting to see some sort of recovery. I think it's easy to react on one day's moves, particularly a day like yesterday. We may have some reversal, but we do actually really need to see some confirmation instead of just reacting to one day.
So what are you looking at specifically in the data to indicate that we are seeing peak inflation? You're saying you have to look for confirmation in markets. What are those signs?
I think the biggest things that we look are empirical trends in asset prices. And what's interesting right now is that you're seeing very, very similar patterns to what we saw during a rising rate environment. And I think what you said earlier in the show about, is this the true bottom of the falling interest rate environment? What we have seen is that we're going to tend to be short in a rising rate environment, particularly when we're going close to an inversion type point, where we're moving into a more recessionary environment. And those are particularly the technical signals we've seen in bonds. And this is actually quite interesting because during those environments, our strategies are going to tend to be 70% short bonds. And if we move into that environment, we're going to see a lot more short bond signals over the next few years.
Is it a crowded trade? I mean, you're in a trend-based, clearly you've hit the ball out of the park this year, but are you concerned that everybody's on board with Katie Kaminsky?
I mean, that's always a question when you're a trend follower. If you follow the trend, you got to get out the doors. But the truth is, very few people are comfortable shorting bonds. And very few people have been comfortable with the trade we've had this year. And that's, I think, why it's been such an interesting year to be a trend follower, because we're doing things that haven't worked since 1994.
Very quickly, are you levered up? I mean, come on, nobody's listening, Katie. You can tell me, are you 3-to-1, 20-to-1? Are you doing a 1998 redux?
No, I mean, we're definitely risk managers in the sense that we run at about 12 vol, which is much lower than what you'd see in the S&P if you looked over a long horizon. I think it's about diversification and finding opportunities across the entire spectrum of bonds, across a large geographical region, and really sort of following macro trends with an eye to many different trades.
Katie Kaminsky, thank you so much. Greatly appreciate it. And congratulations on getting so many facets of this market right. Lisa, we got to go to what we do, which is not trend trading and not CTA work, but just looking at the Bloomberg total return indexes. And I'm sorry, the phrase logarithmically, folks, on the y-axis is yesterday was jump condition.
Yes.
It's stunning to see some of those series.
It's a new regime. I keep saying this. We don't know when we see the peak in yields. We don't know when we've seen the full reset, what the scope of it is going to look like if suddenly the market is pricing in the end Fed funds rate, the Fed funds rate peak of 4% or north of that by next year. How does that reset valuations that have gotten accustomed to a 0% Fed funds rate? This is uncharted territory in a way that so many people are unprepared, and you're laughing. Why are you laughing?
Oh, the language today is just too much. I've gotten more mail on cathartic puke than anything I've done in 3 years. Kaylee, say something intelligent while I give Lisa the number she wants.
Well, as I listen to Lisa talking about all the uncertainty out there, all the things we do not know, maybe that is why we see so little conviction in the market this morning. What does an investor do after a day like yesterday, as brutal as it was, an S&P 500 in bear market territory? What do they need to see to have the confidence to dip their toe back in? Because that confidence looking at futures, Tom, seems like it's waning as we get closer to the opening bell.
Lisa, I just did the Bloomberg Total Return Index, drawdown 16.9% in the IG world.
These are bonds. They're supposed to be safe. These are supposed to be areas of capital preservation. And you're starting to see the outflows. You saw that from LQD. It's the biggest investment grade high bond index. And you saw record outflows.
When you say bonds are safe, my grandfather would throw his blue Standard & Poor's bond guide at you. They are not safe. Futures up 9. Stay with us.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden will travel to Saudi Arabia in July and meet the country's de facto ruler, Crown Prince Mohammed bin Salman, according to an NBC report. No immediate comment from the White House. Biden once promised to punish Saudi Arabia over its human rights abuses. The possible trip indicates his drive to lower gasoline prices and isolate Russia over its Ukraine war. The spending power of UK households fell the most in more than 20 years as wage increases were eaten up by the fastest inflation in decades, according to the National Office for National Statistics. The figures show how pay for most workers is failing to benefit from what is the tightest labor market in living memory. Hayes Fan, a member of Bloomberg News' bureau in Beijing, was released on bail in January, according to the Chinese embassy in D.C. It has been more than 1 year since she was detained on suspicion of national security law violations. Fan's case is said to be under investigation. Bloomberg editor-in-chief John Mithgoldthwaite said, quote, "We will continue to do everything possible to help her and her family." 2 Wall Street banks are withdrawing from handling trades of Russian debt. The Biden administration said last week it's banning U.S. investors from scooping up such assets. J.P. Morgan Chase and Goldman Sachs were still matching sellers who wanted out of the debt with buyers. The U.S. Treasury's Office of Foreign Assets Control says U.S. investors aren't allowed to acquire them. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
The Fed says a 50 basis point hike is coming.
The Fed is telling the markets what it wants them to do.
But what's next?
Some big questions about the next move, the one after that, and ultimately the destination.
So maybe they can let the high prices naturally bring down demand.
Trust Bloomberg for the fastest coverage and exclusive analysis.
The press conference live. McKee in there. It'll be interesting.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg. The fastest way to stay one step ahead.
When you think about it from a trading perspective, what's been missing the entire last several months is sort of what I would call a cathartic flush out, where you get the VIX above 40, which is one of the things you need for at least a trading bottom. This week is fraught with peril.
Julian Emmanuel, the interview of the day yesterday, linking in his equity and quantitative work at Evercore ISI with his boss, Edward Hyman. And Julian Emmanuel making clear that Ed Hyman is looking for a settling of inflation at a 4% level. That is a different statistic. Adamant they don't see a recession out there right now. Lisa, we got markets on the move. Before we get to our correspondent in Washington, BitDog just revisiting 21,000 handle here, giving way, and I'm looking at sterling, a 120.80, 1.2080 is maybe the currency of the moment. What do you see?
I would agree with that, considering the fact that it's breaking down to the lowest level since the heart of the pandemic, and this is on some of those real wages that we saw earlier. I was watching just the futures fading, bouncing around, trying to get a bid, trying to regain a little bit. It's not that active today. There is a lack of conviction. People are trying to retrace some of the moves, but again, it's not a wholesale buy signal, and that alone tells you something, Tom.
Brent crude up $1, 123.23, about $1 below recent highs. Kaylee Lyons with us as well, in for John Farrow today, and again, our Fed coverage tomorrow. Right now in Washington, Anne-Marie Horton joins us. Anne-Marie, it seems like the polarity is so stark in Washington, the hearings and all that, that I don't know where the middle is. Where is the middle, the centrist candidates of both parties right now? Are they hiding in a bunker?
Well, it's a good question, but I do think, Tom, you are seeing potentially one place of middle, one place of compromise, and that's going to coalesce around this gun legislation, or the potential for this gun legislation. It is certainly not as far, and certainly not as far as Democrats want to go. We heard that from the president himself. But at the same time, 10 Republicans are signing their names, and what we're hearing is that ironclad, they want to go for this, and that could potentially get passed through the Senate. That would be something that has taken years for Washington to get around. So there are moments, while I know we always see a lot of partisan hype, there are these pockets of potential bipartisanship in Washington. And I think at this moment, the drafting of this gun legislation, the potential vote of that, could be one.
Anne-Marie, this administration has been throwing spaghetti at the wall, trying to see what sticks in terms of how they're grappling with inflation, whether it's good because of the labor market that's strong, how it's bad, but it's not their fault. What's going to stick? How is this going to really be shaped today at the meeting and the speech that President Biden is giving in Pennsylvania?
So speech today really is going to be about the audience he's talking to, right? So it's going to be about, quote, good paying union jobs, something the president has constantly talked about, building the economy from the middle class out. But Lisa, you make a very good point. They have thrown policy, communication, spaghetti at the wall to trying to see what sticks in terms of inflation. Is it the Fed's fault? Do you pass the buck to Jay Powell? You deal with it? Are we going to see obviously higher interest rates and then potentially lower inflation? Is it Putin's price hike? Is it the issue because we've had such a robust recovery and now a tight labor market? They are obviously trying to get through to the American electorate, which poll after poll shows that this is their number one concern, and not just a reminder of the polls, but every day when you walk or drive past a place to fill up your tank, you're reminded of that inflation every single day. And today, that number is north of $5 a gallon.
How much are Democrats cutting off President Biden as the likely nominee for the next term, but also just as the leadership, trying to find another compass in order to reset for the broader party and not just what President Biden is facing in his poll numbers?
So two things. One, there was that New York Times report recently that talked about the fact that Democrats are weary about President Biden running for a re-election of the presidency in 2024. Not a lot of it is being communicated in public, but this is the talk behind the scenes. But then, of course, you have just yesterday the press secretary saying, of course, the president plans to run. Biden himself saying he plans to run in 2024. This would potentially likely become a little bit clearer, I would say, after the midterm elections.
Emery Horton, got to leave it there with Markets on the Move. Emery Horton in Washington, an eventful June in Washington. Lisa, very quickly here, sterling just plunges. There's no other way to put it, down to a 120.68, just giving way.
And this has to do partly with the dollar that's reasserting some strength and actually solidifying that strength in both the DXY and BBDXY, the Bloomberg broader version. This after initially there was a bit of weakness. The strength is not a positive, Tom. I think that we can say that for the rest of risk assets, when the dollar is strong, it indicates that everything else is being thrown out and people are seeking safety in what they know.
We're efforting people here, folks. Dominic Costa-Mazzullo will join us, I believe, next week sometime. I'm not sure on that. Or is it tomorrow? Thank you,
Yes.
Annie. They're in my, it's the gerbil in my ear here for tomorrow, dummy.
Is it a gerbil?
Dominic Constant tomorrow. Was that Kaylee or Amy? I can't keep track. Dominic Constant tomorrow as well. We're efforting David Folkerts-Landau, who is way out front on this as well. Now, Lisa, as you know, and folks, this is very important. I usually don't speak to anybody before the show. I'm so deep in my preparation. But one of my people told me that the only reason Kaylee could appear today was without a massive plug for crypto surveillance. Look for that this afternoon at 1 p.m. And I mean, you gotta start out. Yesterday, Business Insider, Kaylee, has Scaramucci, runs a wine bar in Davos, Scaramucci out, reaffirming to 100,000 out like 1 year, 2 year, 5 years, who knows. How do you approach the Bitcoin game this afternoon, Kaylee?
Well, the faithful are always going to remain faithful in large part time, but there are a lot of people who are now questioning their faith in cryptocurrencies because even beyond the broader macroeconomic environment, the tightening of policy, the selling in risk assets really across the board, there are also exacerbating factors in the entire DeFi space right now. The collapse of projects like the algorithmic stablecoin Terra USD, Celsius freezing withdrawals yesterday.
What is a stable coin?
It is in theory a coin that is pegged 1-for-1 to the US dollar, but as we have seen in recent weeks, Tom, that doesn't always work. This is a serious breakdown. We're going to break it all down, me and Matt Miller, 1 p.m. Eastern time. I know that's usually the surveillance nap, Tom, but I would hope you'll be tuning in.
Take a window here, MicroStrategy, I think it's called. When do we see margin calls, loan covenants, and that among all these players, these gazillionaires that are less gazillionary now?
Yeah, potentially below 21,000 for MicroStrategy. We're not too far from that level right now.
Gazillionary.
They had gazillions.
He gets
now
on
they
my
got less
case
gazillions.
for my language. Gazillionary.
It's a cathartic gazillion.
Yeah, talk about cathartic puke. Let's look at BitDog. Maybe you should change the name of the show to that. This afternoon, crypto, look for that. Futures up 17. Stay with us. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Bloomberg Surveillance, good morning, everyone. We've got an exceptionally important guest coming up on the global financial system. Mark McCormick, encyclopedic here on Japan and the risks that Japan faces. I want to get to that. I'm going to do a data check at record speed. Kaylee on the individual stocks. The VIX 33.50. I can't say enough about the fragility of futures up 15, Dow futures up 81. It's really not there. Bitcoin moments ago giving way nicely under 22,000, 21,900 right now. Yields are all over the map, 3.30% on the 2-year yield. Dollar strength is indicated by a 105 DXY. And we're watching sterling just as a story of the moment. Sterling 120.90 has just had a difficult morning of it. Let's get right to individual stocks. Ms. Lyons, what do you have?
Well, I'm taking a look at some of those big technology players because, of course, that really drives the direction of the equity market in either direction because they are heavyweights, and it was tech that bore a lot of the brunt of the selling yesterday. But you are seeing somewhat of a lift for some of these. Of course, the ARK Innovation ETF really is the flagship for growth and high multiple stocks. Kathy Wood's flagship fund. It is down 20%, not on the year, not even on the month, over the last 3 days, Tom. Big decline yesterday, though. It's up about 1% in early hours this morning. Tesla's up 0.8, recovering some of yesterday's losses. Apple is up about 0.6%, but all off the pre-market highs as we've seen some of that conviction in the buying earlier on in the session giving way. A couple other more idiosyncratic movers to keep an eye on. One is Oracle. This is actually an earnings story reported after the bell last night. Revenue topping expectations thanks very much to the cloud and strong demand in the database business. That stock is up nearly 12% as a result. Then we have news on Twitter. Elon Musk is finally going to talk to Twitter employees at an all-company meeting on Thursday. That was reported overnight. The stock is up 3.3%. Still, though, just at $38.25. Remember the offer price? $54.20.
So the 54 number
still,
the 54 number still like there.
It's still there. Technically, that was what was signed, sealed, and agreed on, Tom. Maybe Elon Musk is trying to change that now as he's continually kind of pushed back on this deal, raised an issue with bots. Remains a question of whether or not this thing is actually going to go through, but maybe Twitter employees will get a little bit of insight, as will we, come Thursday. And finally, we were just talking about it earlier, MicroStrategy. Michael Saylor has a lot of Bitcoin on the balance sheet of this company. There is now concern that Bitcoin below $21,000 would mean a margin call for this company. After a 25% decline yesterday, it's down another 8% before the bell this morning.
Kelly, thanks so much. I haven't mentioned it, and I've been remiss. Dollar loonie is 129, and 130 on Canada would be something. Right now, from TD Securities, someone who looks at all currencies, someone who's been dead on about dollar resiliency. Mark McCormick is our global head of FX strategy, but we're going to do something different this time, folks. Get out your pens and paper and take notes, replay the video when you hear it. Mark McCormick, a primer on Japan. Mark McCormick, what yen level does Japan need where the system falls apart, this rigged system of modern monetary theory that they have?
Well, thanks for having me. Yeah, I don't think it's a particular level. I think we're getting to the point now where you think about, is there a level you'd like to fade dollar yen, given the fact that JGBs are moving, all these central banks are moving, everyone's imported inflation from around the world, and we're trying to sequence which central banks are moving. It looks like the ECB is ready to move, the SNB is ready to move, and the major question is when does the BOJ go? I think it's not coming in the next month, it's not coming this week, but I think we should be priming ourselves that 135 is probably a top in dollar yen, and we want to think about what level in terms of maybe medium term or longer term fair value do we get to. The biggest long-term trade in terms of valuation is dollar yen is the most overvalued currency in the G10. So if we think about the things over quarters, I think a level that's important is probably 115 to 120 to think about what is an anchor point for dollar yen relative to the policy expectations.
How do you and your Asian team envision you will migrate from 135 to 115, 120, or even stronger yen, a lower statistic? Can it be smooth reaction functions, or is it a mess in jump conditions?
It's absolutely the latter. It's jump conditions. It's definitely a mess. I would say a big part of it is there's some interesting things that are driving yen that I don't think a lot of people spend their time on. And I think one thing most importantly is the movement in energy prices. And Japan is a massive importer of energy and other commodities around the world. So Japan's current account surplus has been eroded. Yeah. And at the exact same time, there's a tremendous amount of foreign direct investment by Japanese corporates out of Japan, which is also weakening the yen. The question is whether or not moving BOJ policy and the change in the U.S. equity markets and the markets, people leaving the United States equity markets and looking for things that are cheap, undervalued, and underpositioned. This is what can help turn the ship for the yen and then say the next 6 months. This is not, again, an immediate risk, but this is kind of that nonlinear effect. If the BOJ moves, U.S. equity markets rolling over, and people are looking for other places to put their money, Japan is going to flag really well on that outlook maybe in the next 6 months or so.
I can't emphasize enough, Lisa, how this is not your father's Japan. This is not about Toyotas and Toshibas. It is a changed Japan, and obviously because of China.
Obviously because of China and also because of the Bank of Japan's potentially futile effort to control a bond market that can no longer be considered a market. Mark, at what point is the Bank of Japan fooling itself, continuing to buy bonds now at a record pace in order to keep yields pegged at this ultra-low level?
Well, they're still doing it now. I think, again, they're kind of getting to the point where the cost benefit doesn't work in their favor. They tried this again earlier in the year when we were talking about terms of trade shocks and higher interest rates and why would the BOJ continue at yield curve control, and they continue to do it. I think what we're starting to see is the rhetoric's changing. There's mixed messages from policymakers. They're trying to coordinate a policy response between the BOJ and the Ministry of Finance. So there's scope here that the boat is turning, and markets are sniffing it out. So I think this is, again, an interesting concept that the policy itself is broken. Markets know it's broken, and they're starting to actively try to find ways to push against it.
So, Mark, how big would the move be in the yen if the Bank of Japan were to abandon the rate peg?
It would be significant. Again, it'd be a knee-jerk. Again, we're talking a lot about, people are discussing intervention. I think intervention is less palpable than the actual policy change. But if we see the policy change, it could see, knee-jerk could be 5%. In the very short run. But again, a lot of it will hinge back onto where we are in the global market cycle, where's risk appetite, where are we at relative to the Fed and other central banks. But the knee-jerk could absolutely be worth a significant move in yen.
Okay, so on the subject of risk appetite, Mark, is that more so what has driven the recent bout of strength in the dollar rather than expectations of tighter Federal Reserve policy?
I think that's a great question because a lot of this year, people have focused on relative themes. We've talked a lot about terms of trade, growth, relative central banks. What's happened since April, and we even got a little sliver of it last month, is people gave up on the broader themes. And what happened is that the dollar and the Fed became all-encompassing. And what the Fed has done through tightening financial conditions is created an equity recession. And risk sentiment has deteriorated, along with kind of the focus on China zero COVID, what's going on with Russia and Ukraine, and how it impacts Europe. But essentially, we're back to that trade now. We're not kind of thinking about terms of trade. You're not buying commodity exporters. You're actually just saying, I'm selling commodity importers like euro, yen, and a couple other currencies. But what's happening is the strength of the dollar is a single meta theme that is basically deteriorating risk sentiment. And what we're doing is bringing short-term cash back into U.S. dollars. So it's really like a 1 electric move here where stronger Fed policy, tighter financial conditions, just as a single strong dollar with really no other themes happening in FX.
Well, and you mentioned the headwinds also facing the euro and Europe more broadly. How realistic is parity?
I think parity is it's definitely a lively discussion. I think, again, if you were to look at option pricing, which is an interesting way to look at things, in the next 3 months, it's still only about a 15% chance that we hit parity. I think obviously we're looking for, we have a trade down, we're looking to revisit those lows under 104. I think the prospects of parity, though, are challenging in this environment because we've already seen the Fed be priced now for 75, 75, 50, 50, and we're already back at a 4% terminal rate.
Mark, well, I got to leave it there, Mark, just because of time. Mark McCormick, thank you for the primer on Japan. Really, really appreciate it with TD Securities this morning. Lisa, I've been waiting for somebody to publish on what happened yesterday afternoon. Nick Timiraos of the Wall Street Journal went on Scott Wapner's show over at the Death Star and talked up the idea of 75 beeps. And, you know, the whole world went basically a frenzy here. And Peter Bookvar is out now with a carefully considered note, Lisa, calling Nick Timiraos the new John Hilsenrath, the new Fed whisperer. I think this needs a translation for our listeners and viewers who are going, what? But they're using the journal as a conduit.
And that's been a traditional conduit, that they've had one reporter that they go to, that they give information to ahead of a meeting to direct markets away from what they might be doing. Tom. Exactly. What this signals to me is that the Fed is watching very carefully what's been developing in markets, and they want to weigh in, but they're in their quiet period and they can't. It is notable that a lot of the turmoil has happened when you do not have the Fed representatives jawboning up a storm. And how do they get a message out? They take this seriously, they are shifting, and they're going to move in an aggressive way, Tom.
Well, okay, but are we talking about 75 beeps tomorrow?
Well, that's a 50-50 chance right now if you look at markets. If you want to do the parlor game that I know that you love so much, the Fed parlor game, you want to play it? Let's play. Citigroup just publishing moments ago, Andrew Hollenhorst saying that a 75 basis point rate hike is a real possibility at tomorrow's FOMC meeting. But we think a 50 basis point rate hike is more likely. At what point do they have to stop promising action and just do it?
Well, yeah, I'll go with that. They've got well, first of all, they're doing it right now. They've got the path underway. It's just you speed up the path, and there's different arguments either way as well. I mean, Kaylee, I look at this, and you know, I guess we don't have to talk about Bitcoin right now, Kaylee, but we can talk about the parlor game and the likelihood of 75 beeps tomorrow. To me, it's all silly.
Well, but you have a string of economists on the street lining up behind 75 basis points tomorrow. You have Goldman Sachs saying not just tomorrow, but 75 again in July. Nomura saying the same thing. We already had Barclays and Jefferies out with a 75 call. And when Michael Feroli of JP Morgan made his call for 75 tomorrow, he said it is a non-trivial risk that the move is actually 100 basis points. This is the reality we're talking about, Tom.
Stay with us tomorrow after the crypto show at 1 o'clock today. The Fed decides in the 1 o'clock hour tomorrow. Futures up a fragile 7. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden in an Oval Office meeting last week with key members of his cabinet indicated he's leaning towards removing some products from the Trump administration's China tariffs list, according to an Axios report. With inflation at a 40-year high, the Biden administration is looking to show action on bringing prices down. Hong Kong's outgoing leader Carrie Lam says the city's quarantine measures have weakened its position as a financial hub. In an interview with Bloomberg TV, Lam pointed to the fact that Hong Kong is still requiring 7-day quarantines for incoming travelers. Still, she says it is unlikely at the moment to allow people to quarantine at home. And Beijing has meanwhile reported the highest number of daily COVID-19 cases in 3 weeks. 74 infections were reported on Monday. That's the most since May the 22nd, when the capital hit a record for the current outbreak. The nation's top official for pandemic control, Vice Premier Sun Chinlan, is urging Beijing to control the outbreak as soon as possible. South Korea's top diplomat says that North Korea has completed preparations for a nuclear test after talks with Secretary of State Antony Blinken in D.C. South Korean Foreign Minister Park Jin said the North would pay a price if it moves ahead. The test would be North Korea's 7th. And hot, dry and windy weather is challenging fire crews from California to New Mexico, with wildfires forcing hundreds of people to leave their homes. Roughly 2,500 homes have been evacuated because of two blazes on the outskirts of Flagstaff, Arizona. The high winds have grounded firefighting aircraft. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now. We are dying slowly but surely, and our lifespan is reducing every day.
Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Significant weak patch in most economic models between Q1 and Q3 of 2023. Whether or not it tips the scales into mathematical recession depends what you're looking at. But the real story is this is a material growth slowdown. And And guess what? Whether it's recession or not recession, that's not the name of the game here.
Francis Donald, lights out yesterday with Manulife. Just really great perspective to get us to an update to the Fed decides tomorrow on the 1 o'clock hour. Futures very fragile, up 5. I can't say enough how fragile they are with VIX 33.75. We're watching sterling under a 121. On a chart, on this inversion, plural, Kriti Gupta.
Yeah, let's start off with the 75 basis point calls, Tom, because as you see in just the last 24 hours, that call has quickly started to become consensus, rolling out very quickly. But let's talk about the implications of it, because one of the arguments to have 75 basis points or even 100, depending on which strategist you're really talking about, is to front load the hikes, get them out of the way, a spoonful of sugar with your medicine, essentially, as we have the Mary Poppins reference. That's really important when it talks about how the economy can actually handle. The question is, can it actually handle those 75 basis points? Folks, for our radio audience, what you need to know is we're looking at 3 treasury curves, the 5s 10s, the 2s 10s, and the 5s 30s. They are all the same color because the spread here doesn't matter. What does matter is that they are all inverted, and it really speaks to the fact that these are all curves that are looked at as this kind of beacon of recession risk, of imminent recession risk. But the question is, if you do have 75 basis points get delivered tomorrow, does that guarantee a recession or does that guarantee a sigh of relief?
Kriti Gupta with the Mary Poppins lead-in, which is a perfect segue here to Lisa Abramowitz, because Lisa, you know, in every job that must be done, there is an element of fun. You find the fun in Snap. The job's a game, including being a bond strategist at Columbia Threadneedle. Why don't you bring in Lisa right now on your bond universe?
Maybe it's Mary Poppins because you don't know what anyone's going to bring out of a hat. It feels like a very uncertain market. Ed Al-Husseini is global rate strategist at Columbia Threadneedle. And Ed, yesterday there was a question of what was prompting a lot of this selling, because we saw moves unlike what we have seen going back to the depths of the pandemic in March 2020. Was this a lack of selling, a lack of buyers, or just simply a lack of anything going on whatsoever and fear pervading?
Yeah, I mean, I would focus on 2 things. First, the Fed has done a really good job of trading markets to look for upside inflation surprises and price in a more aggressive Fed. That's a very important Pavlovian reflex at the moment. And that's really a function of the Fed's communication over the course of the past 6 months or so. The second piece is the liquidity. Liquidity is exceptionally thin in both Treasury and credit markets. And so when we have these periods of rapid repricing, the moves tend to be exaggerated. And that's exactly what we saw starting on Friday and into Monday.
Ed, when things move quickly, things break. At what point do you start to see market functioning break down in a way that catches the Fed's attention and beyond?
Yeah, market functioning, again, particularly in treasuries and in credit, and the fact that it's spread to investment grade credit is definitely a yellow flag. This is one of the reasons the Fed brought its balance sheet to bear in March of 2020. It wasn't just to backstop those markets, but to add liquidity. And I think it's a really unhealthy sign that it's happening this early in the tightening process.
Well, it is early in the tightening process. It frankly has barely begun, Eddie, yet we've already seen these markets move so far. We're looking at a 10-year Treasury yield that is north of 3.3%. At what point do we actually see yields moving lower because of the Havian bid, because of growth concerns, rather than higher on expectations of higher Fed rates?
That's the critical question, because so far we've seen the repricing of the Fed tightening cycle being brought forward. A steeper, faster tightening cycle translate into essentially a parallel move in the curve higher. I think that dynamic was very difficult to sustain when you have risk markets getting weaker. I think there will be a point at which we're seeing right now the curve start to invert, but that inversion will become more aggressive and we'll actually get outright bid for the long end of the Treasury curve. When that happens is a critical question. I think what we're searching for here as market participants is really the level of neutral. Once the Fed is priced to go above the level of neutral, historically the safe haven bid returns to the long end. Clearly, we're not quite there yet.
Ed, I want to talk about the direct actuarial assumption, or oftentimes just to plug in, if your bond portfolio is down 12%, you got to find new cash to put in. And this is the cash refunding of pension plans institutional money that have taken bond market losses. Are we going to have a massive need to infuse cash into defined benefit programs and other quiet money?
It's not clear. I think those programs are quite well funded. The level of funding in defined benefit programs right now is exceptionally healthy if you look at where they've been over the course of the past 15 years.
Yep.
And so there's money to be put to work in fixed income in those accounts. But given the volatility here, there's definitely hesitation to enter the market.
I mean, to me, it's fascinating to see the institutional response to the greatest bear market of all time. What will be that response? How will it be expressed?
The path of least resistance is to look at this market and look at the outright level of yields in high quality credit, look at the level of yields in the long end of the treasury market. And these are exceptionally attractive entry points for medium to long-term investors. And so the question is, when do you start to step in? I think most institutional investors now are looking for a quieter period. You can't step into this volatility because liquidity tends to be so thin. So once this volatility starts to come down, once we get a little bit more certainty for what the Fed is likely to do over the course of the next 6 months or so, those institutional investors should step in.
Ed, just quickly here, before we have to run, how much does the Fed watch this and decide to pare back its reduction in the balance sheet or support markets in a way to avoid some of that yellow flag that you say with investment-grade bond yields?
I think it's an excellent question. In my mind, odds are very good that the Fed will have to stop drawing down its balance sheet much earlier than they anticipate on its current trajectory. When they'll do it, I mean, look, I think it's very difficult to do it while you're still hiking. It sends, I think, a mixed message to the market, but it's likely to happen much earlier than they currently anticipate.
Ed, thanks for the brief. Ed El-Husseini with us with Columbia Threadneedle today. Lisa, I look at the 2, 10, and 30-year bond, and they're all basically 3.32%. I mean, basically, we've brought the yield curve back to a perceived terminal value. Can you imagine where those yields will be if we adjust our terminal rate higher?
Well, and how much of an inversion and how much of, yes, adjusting higher all across the board, but still longer-term pessimism for the shorter-term inflation that's going to prompt a further action. What Ed just said there is jaw-dropping, that he thinks the Fed's going to have to stop drawing down their balance sheet way or sooner than a lot of people think because of the dysfunction that you're starting to see uncomfortably quickly happening in the credit market.
He skirted the question, which I understand, but I'm sorry, the dysfunction, Lisa, is front and center.
And especially when you see things moving this quickly in markets of full faith in credit that are considered safe. I'm not saying I do. I'm saying that some people call them safe.
Yeah, I go Liz Goldenberg 101, the bond giant of Bloomberg. Guess what? Bond, price matters. This is Bloomberg. Good morning.
Connection lost.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dinings, shopping. But many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada. Tapi Nggak kayak dulu. Kalau dulu ramai sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
This is going to be a very different communications or very difficult communications challenge for all central banks.
The Federal Reserve is going to follow the inflation expectations.
The difference between soft, softish, and something else is very fine.
This economy is going to require higher real yields to slow down.
Trying to satisfy the market and short-term inflation outcomes might be the wrong approach.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
A messy end to a low-rate era. Good morning. This is Bloomberg Surveillance on Bloomberg Radio and Bloomberg Television. Tom Keene, Jonathan Farrow, Lisa Abramowitz, John Farrow off. Kaylee Lyons very much in with all of her encyclopedic knowledge. Are we there yet? Have we seen capitulation? And how much further do we have to go, Tom? It is a tepid tape with people trying to buy.
It's a fragile tape. Futures up 7. I really want to emphasize here, Amy, give me the chart if you can right now. Futures have not been read this morning at 2:17 a.m. We had the peak enthusiasm of the day, and it's been at least a glide path down on the cusp of going negative. But maybe with the president's announcement to Saudi Arabia moments ago, oil pulling back $1 for a moment, and futures getting a little bit of green on the screen.
What I gather from the people who we speak with is a lack of conviction and a lack of understanding of exactly what's driving this. Yes, it was the inflation print on Friday, but what is the response mechanism, Kaylee? And I know that you've been covering this really well. The response mechanism with the Federal Reserve poised to raise rates by 75 basis points, maybe, according to some people, as soon as this meeting. Would that be perceived as a good thing or a bad thing for markets looking for some harder action from the Fed?
I think that's a very interesting question, and frankly, we aren't going to know the answer to that question until 2 p.m. tomorrow, which is probably why you aren't seeing that much conviction this morning. But it does raise an interesting point. If inflation is the problem and you risk running inflation hotter for longer if the Fed is too dovish, does then a Fed that is more hawkish, but kind of hawkish that the market now seems to be giving them permission to be, actually the better scenario? This is definitely, it's a different kind of narrative than one we had prior to that CPI print on Friday.
And Tom, you've been really good about emphasizing how it is a tentative tape. This is not one with conviction. It's fragile. It's been moving around. The dollar is just trying to weaken, with people saying maybe we can move away from this, and yet continuing to reassert its strength versus the pound, versus other areas that people have been watching. How much can we avoid some risk-off environment as long as the dollar continues to be the haven and you see that underlying bid?
Yeah, we don't want to give our opinions here, folks, buy, hold, sell on anything, but we can look at the drift of any time series and say, what's a conviction, what's a belief? Obviously, everybody, Lisa, waiting for news flow, but you look at the individual items, including sterling, well under 121, 120.83, crude still at a 123 level, exactly 122.98 on Brent, and the flightiness of the curve inversion, Lisa, is remarkable.
Well, yeah, although hovering around that flat to negative kind of feel as we look at near-term very high inflation, long-term slower growth. Also watching the NASDAQ, considering the fact that it's up 0.6%, outperforming the S&P. Just to put into perspective, the NASDAQ is down more than 30%, Tom, year to date. That, to me, blows my socks off, considering some of the drawdowns during the 2000 bubble. We're getting close to that, Tom.
I'm glad you bring that up and that these larger moves are important. Linda Dussel at Federated got us started this morning, and I really want to reframe that into the data check of a correction, 10%. My bear market is 18%, but the history of down markets is not 18%. It's much more 25, an even market down to some history moments of 35% as well. On the data check, a dollar resilient, a 105 DXY, yen 134.42, euro resilient 104.49 this morning. Sterling, the lead story, weaker 120.80. Futures bounce off, up 6, now up 14. Dow futures up 82. The VIX 33.64. Lisa?
Yeah, although yesterday was a scary day for some people. That was their words, not mine. I think that people were looking at the nature of selling or perhaps lack of buying and not fully understanding the depth of it. Among those, parsing the tea leaves that Tom has been talking about, Sarah Malek, Chief Investment Officer at Nuveen, managing billions of dollars for your investors. Sarah, what were you doing yesterday as markets melted down?
Well, we're thinking about the next 3 months. We're looking at 3 FOMC meetings and 3 options for rate hikes, 50, 75, or 100. And what that's going to depend on is whether we see signs of moderating inflation or demand destruction. Unfortunately, there's no signs of inflation alleviating. We saw that with CPI, which was up broadly. There are signs of some demand destruction, but the key question is, has the market priced in maximum Fed hawkishness? We don't think that it has. Looking at 2023 earnings of about 250 on the S&P and a below average market multiple, you could see the markets trading down here at about 3,600, likely in a trading range up to 4,200, but we're not going to break one way or another until that inflation starts to moderate, and we're just not there yet.
Sarah, I got to ask you the Nuveen question, because you invented it. You own the high ground in Chicago, and that's on tax-free bonds. I mean, in everything you're doing in equities, is the shop saying you need to take advantage of tax-free bonds right now?
Well, the good news with municipal bonds is that the fundamentals are very strong from a state level. It's the macro headwinds of higher rates that have been an issue here. But if you look at total return for areas such as high yield munis, they look really strong here. So that's an area we think is interesting at this point, because once some of these macro headwinds move out of the way, the fundamentals are going to be in place for that sector.
And now we got to ask the unfair question of the day. We do this with Sarah Malek with her focus on equities. Do you suggest within Nuveen research that the tax take of some of these states is going to sustain, or is it a pandemic one-off?
I think that there is going to be some normalization post the pandemic. We're seeing that across the board in a lot of sectors, but it's still going to be a high level going forward. So it's not going to normalize to below average levels. So this trend continues. There is some pain as you go through the normalization. We're seeing that across the board with many companies.
I mean, it's amazing, Kaylee. Sarah Malek just crushed that. I'm asking her narrow muni bond questions, and she just absolutely nailed that.
Well, why else do you think she's on the program, Tom? Because she's smart and she answers our questions. Sarah, a question for you. What would you be buying on a morning like this one?
Well, we're looking across a few areas. Number one, coming into this year, energy was our favorite sector. We like the tight supply dynamics of the sector, strong demand, but importantly, producer discipline. Producers are focusing on returning cash to shareholders rather than on just barrel growth. That keeps the sector tight. I think keeps energy stocks strong for many years. let's turn to the consumer. A lot of trouble here with Walmart and Target, but for us, that was more company specific based on that lack of spending on goods. Consumer likely trades down, looking at areas such as Costco, resilient subscription model, ability to raise prices for Costco, and also TJX, which is more of an off-price retailer. We like areas. And then you talked about growth stocks earlier. I mean, the Nasdaq's been hit so hard. We're looking for quality, strong companies like Salesforce in that area. Very strong push to digital, strong booking, strong customer growth. And importantly, they're helping their customers grow revenues. And with margins at peak levels, revenue growth and pricing power is going to be key for companies to grow earnings.
You mentioned their Target and Walmart. I guess you think they're more kind of idiosyncratic inventory management issues at the company level than anything emblematic of something broader happening in this economic environment as consumer tastes change. You don't think this inventory buildup, this inability to pass on higher costs for certain discretionary goods is going to be a broader problem, Sarah?
I think that, look at the consumer, they're continuing to spend, they're starting to eat into their savings. That is a risk that we're watching. So there are cracks in the consumer, some cracks in the labor market, higher interest rates, all of that I think is a risk for the consumer. But Walmart and Target, this was an issue of what happened during the pandemic. People were spending so heavily on goods. These companies were having such trouble gathering inventory that they basically overplanned and the spending on goods shifted. We're now spending more on services, more on experiences, and they ran into an inventory problem. And I think that is, while it's a sign somewhat of a consumer macro problem, that was specific to Walmart and Target and not an issue that would be a broad retail issue.
Sarah, thank you so much. Sarah Malik, just there and a real champ to talk muni bonds with us as well, with the Muni Bond House, Nuveen, and all that they do across other asset classes as well. Lisa, I guess this is going to be the next number of days. We mentioned with Kaylee Lyons, crypto expert, MicroStrategy, but there's a headline from Coinbase, which, to be honest, I really don't know what Coinbase does, folks.
It's a crypto exchange, Tom.
But they're going to cut the size of their team by about X%. I mean, Lisa, I think we got to go to Kaylee on this. Folks, look for crypto surveillance today at 1 p.m. Kaylee, we're going to see a lot of this, right?
Well, in the crypto space, you likely will. We've already seen it from a number of companies. And Brian Armstrong, the CEO of Coinbase, in this letter is saying there's a number of things that have changed just over the last month that have led to this decision to cut about 18% of jobs. One, he says economic conditions are changing rapidly. Of course, we know companies across the board are dealing with it. They say managing costs is critical in down markets. Again, that isn't just exclusive to crypto companies. Everyone is having to do that in this inflationary environment, in a market in which it has been absolutely brutal. And finally, we grew too quickly, Tom, is the third reason that he gives there.
At least I'm going to punch somebody.
I just think about back when we were at Davos and we were talking to Scott Minerd of Guggenheim, and he talked about how he had been a bull on crypto assets, and then he saw the sell-off and there was no reason to buy the dip, and he saw it heading to 8,000. And that's looking somewhat prescient today, and we have him on tomorrow for the Fed special, so maybe we can ask him about it. Tom.
Say something, Kaylee.
We're doing this again?
Kaylee.
Tom, would you like to phone a friend? Is there anyone you'd like to call?
Say something smart, Kaylee, so I can look at some charts.
Did they really publish in their press release that they were bad because they grew too quickly?
Yep, this is the quote. At the beginning of 2021, we had 1,250 employees. At the time, we were in the early innings of the bull run, and adoption of crypto products were exploding. ... While we tried our best to get this just right, in this case, it is now clear to me that we overhired.
Do you have a bolt onto the Tang this morning?
Did we have? Well, hold on a second.
Does that not sound like Amazon with their warehouses and employees?
That's exactly what I was thinking. I'm so glad that you said this. It's not just Amazon. There were also Microsoft talking about that as well. It was a number of companies that expanded and benefited the most during the pandemic.
Futures up 10. Let's do a quote on BitDog, 21,904. Crypto, 1 p.m. Be there. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden will travel to Saudi Arabia in July and meet the country's de facto ruler, Crown Prince Mohammed bin Salman. Biden once promised to punish Saudi Arabia over its human rights abuses. The possible trip indicates his drive to lower gasoline prices and isolate Russia over its Ukraine war. Hong Kong's outgoing leader Carrie Lam says the city's pandemic measures have weakened its position as a financial hub. In an interview with Bloomberg TV, Lam pointed to the fact that Hong Kong is still requiring one-week quarantines for incoming travelers.
Who believes in relativity. So everything is relative. When people are opening up,
and Hong Kong is still imposing a 7-day designated hotel quarantine, that to a certain extent weakens our position as an international city.
Lam also conceded her government could have prevented elderly deaths with a stronger vaccination drive, but did not apologize. And Hong Kong residents will now have to show a negative COVID-19 test result to enter the city's bars and nightclubs starting on Thursday and running through the end of the month. The decision comes as the city is seeing an increasing number of infections, in many cases driven by transmission at entertainment facilities that recently reopened. Hayes Fan, a member of Bloomberg News' bureau in Beijing, was released on bail in January. According to the Chinese embassy in D.C., it's been more than 1 year since she was detained on suspicion of national security law violations. Fan's case is said to be under investigation. Bloomberg editor-in-chief John Micklethwaite said, quote, "We will continue to do everything possible to help her and her family." Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
The Fed says a 50 basis point hike is coming.
The Fed is telling the markets what it wants them to do.
But what's next?
Some big questions about the next move, the one after that, and ultimately the destination.
Maybe they can let the high prices naturally bring down demand.
Trust Bloomberg for the fastest coverage and exclusive analysis.
The press conference live. McKee in there. It'll be interesting.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg. The fastest way to stay one step ahead.
If they're going to do 75, it's better to do it sooner than later when policy is still at a very low interest rate. But it also goes to the fact that they've sort of lost control of the dialogue over this. I mean, they need a monetary policy approach that they can sustain.
Stephen Whiting, he is with Citi Global Wealth Management, chief economist, chief investment strategist, just wonderful at linking in earnings and profits into the greater picture. We're going to digress right now. This with futures up a fragile 12 after yesterday's festivities. The VIX 33.68. With Lisa Bramwitz and I noting 3.33% 2-year, 3.34% 10-year, 3.334, whatever the numbers are.
Whatever.
They're all pretty similar.
They're all the same. They're flat.
They're all the
and
same.
that's what you're seeing.
The yield curve is flat.
Bring that through. That is a well-said thing.
Did
and
I
you're
do
actually
okay?
seeing it. You did great. And on the longer end, when you look at the 3s 10s, the 3s 30s, or the 5 30s, you're looking at inversion in many pockets that are creating some concerns.
The terminal rate reality is really something here. James Camp joins us now, strategic income at Eagle Asset Management, who's been dead on about higher yields. James, do you just assume the so-called verbiage of a terminal rate moves higher, and that flat yield curve we just described goes from 3.32, 3.34, 3.34, and that migrates up near 4%?
Well, I think long-term interest rates are going to find a footing here, probably around these levels. We did violate the 325, which was the high of the 2018 experience. What I think is happening is the Fed and the markets are tightening credit conditions even more rapidly than the projected funds rate. And I think that's what the market may be missing. You know, with equity volatility, with equity prices, with spreads across the high yield IG space, investment grade space, the Fed is crushing credit conditions. And that is, in fact, I think part of what they're trying to do. This is full-on demand destruction. We got to slow the economy. Maybe we touch recession, but the only way out of this miscue, if you will, in terms of timing of the Fed getting the inflation story right, unfortunately, is to slow aggregate demand, and that's what they're focused on.
James, Ed Al-Husseini of Columbia Threadneedle was just on about a half an hour ago, and he was saying that he could see the Fed stopping the runoff of the balance sheet because of some of the credit conditions, because of how quickly the pace of tightening of financial conditions, particularly with respect to top-rated companies. Do you agree?
Yeah, I think that's possible, Lisa, but I don't think that QE in QT, if you will, I don't think the data is very revealing. I think it's ambiguous at best, the effects of the quantitative tightening or the runoff. And I don't think at this point, given what's happened with broad risk markets and what's happening with the inflation data, there's really any choice. The Fed's left it no good options. And unfortunately, we're going to have a couple quarters of this, and we'll see what happens thereafter.
So right now, do you buy into this if you're looking for income, considering that you're getting income, the likes of which you haven't seen since 2009, or do you step back because there's nothing that's going to stop the runaway sell-off in the very near term?
No, I do like the income markets. I like the fixed income markets. I like quality. I like treasuries here. I think spreads still have room to widen, including high yield. I think the municipal bond market, for those in the non-qualified world, those looking for tax sheltered income, probably have some of the most generous yields they've had in a number of years. And by the way, July, Lisa, is, as I know you know, will be a massive redemption, massive cash flow month. And I think we're going to reverse the big negative outflows from municipals. So the income space and fixed income is very generous. As you mentioned, we were 40 basis points on the 10-year just two and a quarter years ago. So it's a pretty extraordinary move.
And you say you like treasuries here, that there may be value now that yields are north of 3.3%. When do you think more people are going to come into that camp, James?
Well, I think it's close. And obviously the risk market's having these massive hiccups, being in a correction full stop in S&P and the NASDAQ, that you're going to get sort of this rotation and flow of funds data, I think, comes back into the bond market. Ultimately, as we've thought, the Fed now no longer being the indiscriminate buyer, in other words, every month coming in with 120 billion, yields are going to have to find a place where real investors, real hard dollar investors were interested. And I think that's upon us right now.
James, thank you so much. James Camp with Eagle here on the yield here, 3.31, 3.33, 3.34. I think it's a flat yield curve. I just looked at the weighted average cost of capital at Coinbase. And Lisa, I'm telling you, I guess it's trouble. They've got a 9-year piece out as well, the 3 5/8 of 31, and it's yielding near 11%. In Kaylee Lines, it's down 41% in price from September. I mean, Kaylee, is Coinbase a going concern?
Well, possibly. I mean, that's not the only price that's going down, Tom. You also have Coinbase shares that are down dramatically over the year. They're down another 7% or so this morning after this announcement that they're cutting 18% of their workforce. And the CEO, Brian Armstrong, literally saying, we grew too quickly. We were too aggressive on hiring. And now that the environment has turned to one that was bullish to one that is quite bearish, a crypto winter, as you call it in this space, things have to change. And what that translates to for Coinbase is cutting 1,100 employees. But even outside the crypto ecosystem, Tom, this is something we've heard from other companies.
This is what's right. Lisa, help me here. I wish Pharaoh was here. He'd go, what in God's name is a crypto? Lisa, what is a crypto ecosystem beside a made-up marketing phrase?
Look, you can call it whatever you want, but a lot of people bought into it. And with Coinbase, it's not just the average Joe or retail investors that bought into it. It also was institutional investors, and it was also individuals on Wall Street who wanted to leave Wall Street to go to the crypto universe, to the ecosystem of crypto magic. And a lot of those people, actually, a number of them saw their jobs revoked at Coinbase just recently. They left Goldman Sachs, they left BlackRock, and then they got a notice saying, actually, we don't have a job for you. So how much were the tea leaves there that things were rapidly shifting for the future of finance as people envisioned it a year ago?
There's a small New York City toothpaste company called Colgate-Palmolive. Do you think they sit around the desk at Colgate-Palmolive talking about the Colgate ecosystem?
I'm not sure how to respond to that, Tom. I think, but I mean, these are ecosystems. That's how you talk about them. It's an emergent ecosystem. That much is abundantly clear in that you're starting to see some of these projects that people had a lot of promise, a lot of hope in, completely devolving. Lisa,
you know how you answer that? You really want me to talk about toothpaste ecosystem in response to the Coinbase and the crypto asset ecosystem? Really?
Do you see, Lisa, how Kaylee gets totally engaged about crypto?
Well, she should. Well, she has a great show, and it's a great moment for it.
What are you doing today on the show, Kaylee, within this bombing? What do you got today?
Well, we're going to talk to one guy who called the asset freeze withdrawal of Celsius, the man, Mike Alfred, over. Will be speaking with us, and Nick Carter as well, who's a big voice in the space. And we're going to take a look at the technicals, too, because they matter in this ecosystem a lot.
Great. John emails in from Capri. Enough of BitDog. This is Bloomberg. Good morning.
estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modificaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Good morning, everyone. Bloomberg Surveillance. Lisa Abramowitz has been talking about regime change, and one of the regime changes of this regime, as we look back at an old kind of inflation that we used to stop 20 years ago and say, we have to look at this. Michael McKee now stops and takes a look at business inflation, the three levels of PPI. Michael.
Well, PPI is just going to add to the pressure on the Fed. The numbers come in about as expected, which is a little bit of a dip in the headline, but not enough to get anybody excited about inflation going away. We see an 0.8 rise on a month-over-month basis. That's higher than the 0.5 rise last month. But because of base effects, we see a year-over-year rate of 10.8%. It was 11% last month. So the year-on-year headline dips a little bit, but with the PPI like CPI, we want to look at the core. And excluding food and energy, we were up by 0.5. That's more than the 0.4 that we had seen, and that means an 8.3%, down from 8.8% base effects. But with the PPI, we add in trade services, which is basically, if you want to look at it this way, it's essentially retailers' margins. It's what they're having to pay for the goods that they buy and then sell on to you. And including that, we were up 0.5, which is a bit of a drop from 0.6 the months before, 6.8% on a year-over-year basis. So the news is, marginally better, but it's not going to change what the Fed is thinking tomorrow, especially with CPI and those numbers coming in, Tom, on the Michigan numbers and New York Fed numbers for expectations.
Lisa, did the markets move?
A little bit. I mean, it's a marginal move, to Mike's point, a marginal downside surprise, the one you kind of want to see. It is not coming in as hot as people expected. The NASDAQ in particular, climbing 0.8% ahead of the open in futures, the S&P up 0.5%. Two-year yields just slightly touching 3.28%. So really kind of just a little bit more of a bid to the bond market. And then the dollar, you saw it soften just a touch, but really, Tom, showing that it's really people are looking for any sign of relief from some of the worst case inflation runaway kinds of projections.
I got a 10.8% PPI final demand year over year. Michael McKee, is this the first look at double-digit inflation?
Well, no, because it was 10.9% last month, initially reported as 11%. You know, we tend to look at the year-over-year figures because it's the most dramatic, and those double-figure numbers are certainly scary. But what you're going to look at if you're the Fed or other people is the month-over-month, because you're looking for sequential gains, and that's what we're seeing here. We're seeing the situation get worse. The base effects bring the year-over-year number down a little bit, but we doubled the PPI in the month of May from April. The increase was 0.4 in April, it was 0.8 in May. So things are not getting better. Now, a lot of that is going to be energy, of course, but that's what the Fed's going to be talking about tomorrow.
Okay, I got like 8 more questions. We'll have to do it later. Michael McKee leading our coverage tomorrow. The Fed decides 2 p.m. He will be in the press conference in Washington with Chairman Powell. Michael McKee, whispering always at the Fed. Right now, Carl Weinberg with us, chief economist, High Frequency Economics. Lisa wants to dive into the international feel. Carl, I've got to go to your scathing China note. I believe it was yesterday, where you say flat out, we can't trust the Chinese data. How close to worser is China?
Good morning, Tom. Good morning, Lisa. China's numbers are surprisingly strong. The trade numbers are surprisingly strong. We can make up a story for the import side that perhaps points to a very, very big drop in the volume of imports, assuming that import prices went up. But the export numbers are just over the top. It's hard to believe that with the ports closed for at least half of the month of May, that we saw a 15% year-over-year rise in exports. So I'm skeptical of the numbers that we're seeing. Of course, we'll get more numbers this week. We're going to see retail sales and industrial production and fixed investment spending at the end of this week. Let's see if they paint a darker picture of the economy, more aligned to what we expect to see.
Carl, do you see anything that's going to put a crimp on the inflationary kind of pressure that we're seeing upward in the near term?
Well, the central banks are going to put a crimp in things.
Aside from them.
Well, but that's really the core story here. Every time central banks have gone out shooting for inflation, they've caused a recession. And almost every time we've seen a recession, we've seen prices fall off dramatically. You know, few people remember how fast inflation dropped from just before the spring of 2008, the economic peak, until 6 months later, we went from inflation to deflation, and oil went from $140 a barrel to $35 a barrel. Now, that was a really big hit to income, really sudden, really unexpected. But every time we look back in history and we've seen the economy go into a recession or a period of slow growth, we've seen prices slow rather dramatically. So that's the story here. You know, you look at the current data, and it's very fair to say there's no evidence in the current data that inflation is slowing. That's true, but that assumes all other things remain equal, and all other things will not remain equal. The hike in interest rates that we're seeing from all the central banks around the world, except for the Japanese, is going to slow growth, and that's what's going to bring prices down.
This is incredibly important, Carl, because a lot of people were saying that the only way for the Fed to achieve a soft landing was if other aspects coordinated with it, exogenous risks abated, and allowed a weaker or a slowdown in inflation that was faster than some people had been expecting. If that is not the case, Carl, is it basically, they're going to cause a recession? They need to cause a recession in order to get price control into the market.
Well, you know, Lisa, we heard Fed Chair Powell say a few testimonies ago that the Fed's track record on soft landings isn't really that good, that he could only think of 1 or 2 instances in the last 50 years when they actually achieved one. Maybe this time will be different, but there were 6 episodes of interest rate hikes by the Fed that preceded or were associated with the last 6 big economic downturns in the United States, and we see the same thing for the Europeans and for the English as well. So, that's certainly going to be a factor. The exogenous factors are going to go away, all right, for sure. Oil prices are not going to continue to rise. And again, as we saw back both in 2008 and in 2020, if the economy gets slammed hard, oil prices can go from $140 a barrel to $35 a barrel in 6 months. They can fall just as fast as they went up. And that's, I think, got to be part of everybody's thinking.
Well, the thinking goes that the cure for higher prices in the commodity complex eventually is higher prices, that eventually demand destruction will kick in. We have seen sentiment waning, Carl, and yet you haven't necessarily seen the robust demand destruction when it comes to actual consumption, to consumers being willing to spend their money. When does that start to happen in a more robust way?
Yeah, hi, good morning, Kelly. Yeah, I mean, we just have to be a little bit patient to see it work out. Right now, we see evidence consumers in the United States are running up their credit card debt. We see evidence that they're reducing their savings. These are all ways to cushion the impact of a drop in real income, which is what's being caused by the higher energy prices and other prices that households are facing. But that can't go on forever. And I think we just have to be patient that it's coming. Everything we know about economics says it's in the works. It's just not here just yet.
What should they do tomorrow, Carl? You've been doing this for decades. You've got tons of experience, back to Arthur Burns and even McChesney Martin. What should Jerome Powell do tomorrow?
Well, I think he's got to pursue the course of convincing people that the Fed is going to do whatever it takes to fight inflation, to not let inflation expectations become entrenched in wage demands and consumer spending behavior. Ben Bernanke had a piece in the New York Times today saying exactly that. And I got to agree with former Chair Bernanke that that's the most important thing that the Fed can do. You know, we've been teasing high-frequency readers with an article from the Economic Bulletin of the ECB from May of 2010, written by the Bundesbank, explaining why Germany fared better in the great inflation of the 70s than the United States.
Right.
And their answer was they established a credible target for monetary growth, a credible target for inflation, and they stuck to it. And I think that's the most important thing that the Fed can do right now.
Carl Weinberg, thank you so much. Great briefing here as we go to the Fed show tomorrow. We'll have that for you in the 1 p.m. hour. Michael McKee in Washington. Lisa, I love this sentence. This is from Michael Lenz, the CFO of Federal Express. The increased dividend we announced today is the culmination of our board's thoughtful efforts over many months. Hogwash, total, absolute hogwash. D.E. Shaw went after FedEx. They announced today a new use of cash with a 7.5% move in the stock, and the dividend explodes higher.
How much is this going to be an increasing strategy for companies that are being buffeted by all the uncertainties and don't see a place to put their money elsewhere? I point to Target and Caterpillar among those companies that have also boosted their dividends. Target being most interesting among them after cutting their forecasts several times in the same number of months. How much are we looking at companies that do not see an optimistic place for their cash, and they're going to return it to shareholders to be disciplined and support the valuations?
I mean, buffeted by the pandemic, no question about that, but the model for FedEx out right now on free cash flow and, importantly, cash from operations, Lisa, this is not Coinbase. This is a money-making machine, as we all know when we send the package out.
And it wants to remind its shareholders of that by saying, here you go, you can have some. And how much is this getting ahead of what's to come in terms of the turmoil to bolster their position? But also, again, where else are they going to put it? If people are not confident in the future, where do investments go? And that's going to be something that you've been asking a lot about, Tom. Where do they put their cash? What do they do with their cash?
What do they do with it? And the catalyst here of D.E. Shaw, I mean, FedEx announces actions to enhance stockholder value and updates to board governance. So an important announcement there, and maybe we'll see much, much more of this in the coming months. I guess, Kaylee, I'm not going to see that announcement from Coinbase.
Yeah, no, it's not looking likely. Brian Armstrong says that reining in costs in this environment is really what the company has to prioritize. As a result, they're cutting their workforce. It was a different environment just a month ago. That is what he said. He has said things have rapidly deteriorated over the last month, and Coinbase isn't the only one that's feeling that.
On FedEx, D.E. Shaw agreed to some customary standstill provisions, so I guess they've come to an agreement. We agree to stay with you here, a most eventful morning. Futures lift, futures up 27, a better tape.
Keeping you up to date with news from around the world with the First Word, I'm Ritika Gupta. President Biden, in an Oval Office meeting last week with key members of his cabinet, indicated he's leaning towards removing some products from the Trump administration's China tariffs list, according to an Axios report. With inflation at a 40-year high, the Biden administration is looking to show action on bringing down those prices. Hot, dry, and windy weather is challenging fire crews from California to New Mexico, with wildfires forcing hundreds of people to leave their homes. Roughly 2,500 homes have been evacuated because of two blazes on the outskirts of Flagstaff, Arizona. The high winds have grounded firefighting aircraft. The spending power of UK households fell the most in more than 20 years as wage increases were eaten up by the fastest inflation in decades, according to the Office for National Statistics. The figures show how pay for most workers is failing to benefit from what is the tightest labor market in living memory. South Korea's top diplomat says that North Korea has completed preparations for a nuclear test. After talks with Secretary of State Antony Blinken in D.C., South Korean Foreign Minister Park Jin said the North would pay a price if it moves ahead. The test would be North Korea's seventh. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Important part of patriotism is to develop American technology, because I think we will have a techno-economic war over the next 20 years globally, and the U.S. venture community can make a large difference in that.
The gentleman always and forever from Sun Microsystems, Vinod Khosla with David Rubenstein, Bloomberg Wealth. A very, very important conversation with someone who has always over the decades tried to think harder than everyone else about what the future will bring. David Rubenstein joins us now. I do want to mention first, though, the tape doing better off the PPI data. We've come off the bottom of the two-day gloom that we've had. David Rubenstein, on Vinod Khosla, what to me is so important is Ian Bremmer's essay last year on the power of technology. You talked to Mr. Khosla about technology and the tension between China and the United States. Who holds the power?
Well, Vinod Khosla, for those who don't know, has been one of the leading venture capital investors in the last several decades, first at Kleiner Perkins and now at his own firm, Khosla Ventures. And he is an Indian immigrant. He came to the United States, got his degree at Carnegie Mellon and then Stanford Business School, started Sun Microsystems, as you said, one of the founders there, and really has made some of the most impressive venture investments over the last several decades, making billions of dollars for his investors. He said that he thought there was a war, perhaps a economic war between China and the United States that could arise over the next 20 years. And he thinks that his native country, India, could be an ally in the United States in that war. There's no doubt that there's technology tension now between China and the United States, and he thinks the venture capital community can play a big role in trying to moderate that tension to some extent and maybe bringing those countries together by cooperating to some extent, if possible, on technology investments.
And David, as you as a leader on this, and I want to bring in Dr. Bremmer's thoughts from his essay last year, there has to be a responsibility on the part of the young Turks of technology in America to think internationally and think interdependently. Are you optimistic they're able to do that?
Well, I think they're more likely to be able to do it than our political leaders are going to be able to do it, because I think the political leaders are right now at loggerheads about how to cooperate. But certainly the business people are willing to cooperate and can, if there are not government challenges. Sometimes the government puts blocks in between between cooperation between venture investors from China or India or United States. So I think the technology community recognizes it has the future of the global economy in its hands to some extent, because so much of what we're now doing, the way we live, is dependent on technology investments. 20 years ago, people wouldn't have said they could, they didn't know about Google, they didn't know about Apple, they didn't know about Facebook, and now we can't live without some of these companies, or Amazon as well.
Well, we can't live without some of these companies, and yet they have seen their share prices decline rapidly in remarkable fashion this year. Valuations really coming in across the tech space. David, what were his thoughts around that, on these valuations becoming a bit more depressed?
Well, it's one thing when you had the bubble burst in 2000 or 1999 and 2000, because you had companies that had no revenues and had essentially no earnings at all. Now you've got gigantic companies, Apple, Amazon, Google, Facebook, Netflix, that have large amounts of revenues and earnings. So yes, maybe the valuation is a little bit high today. I wouldn't think that these companies are going away the way that some of the companies went away in 1999 and 2000. These companies are now embedded in the fabric of our society, and I just think their valuations may fluctuate, but it's not like they're going away.
Okay, well then let's talk about some other more nascent companies that maybe are seeking venture money. The exit may be getting a little bit more difficult. It would be a rough market to go public in. It is a rough market to raise capital in. I mean, how is venture changing in an environment where money is no longer free?
there's no doubt that valuations have come down in the private market as well as the public market. But these things happen from time to time. The question is whether it's a good company or not. Take SpaceX, for example. It just raised money at a very large valuation. I think a valuation of over $1 trillion, and not over $1 trillion, but they raised $1.7 billion, I believe it was, at a very high valuation. I think the valuation was $125 billion. I think eventually they think they might get it to $1 trillion. But there's a valuation where $125 billion more or less valuation for SpaceX is still a large amount of money to raise in the private sector at a large valuation. So the technology valuations have come down for sure, but they're not exactly disappearing and going to zero.
David, very quickly here, we've got to get back to these crazy markets. You said a number of months ago, maybe weeks ago, that the genie's out of the bottle on crypto. We are seeing painful losses in Bitcoin right now with announcements from people that immensely respect Carlyle and what you've done for years. Give us an update on Bitcoin and the rest. Is it believable?
Well, I'm not the lead. Genie's out of the bottle. I don't think these things are disappearing. Their values will fluctuate for sure. But suppose you bought Bitcoin at 50 cents or $1, as many people did, and now it's at, what, $20-some thousand still very high. So sure, if you bought it at $60,000, you've lost a lot of money. And I'm not saying these are great investments, but I think these are investments that aren't going to go away. And I don't think the whole crypto economy is going to collapse, nor do I think blockchain is going to disappear. Blockchain is an important part of a lot of these cryptocurrencies. So we're obviously in a market decline, and in a market decline, everything goes down. So it's not surprising that something that is as ephemeral as crypto would go down. But I don't think people are going to basically abandon the whole concept of cryptocurrencies just because the market's down for the last couple of weeks.
David, thank you so much. David Rubenstein with Vinod Khosla, and look for that, of course, tonight, 9 p.m., Bloomberg Wealth as well. Kaylee, I just did that so you got a nice soundbite for crypto at 1 p.m. with Mr. Rubenstein saying don't throw the baby out with the bathwater.
Yeah, I appreciate that. We can replay that sound at 1 p.m. Eastern Time. Really excited for that conversation. But as David said, Tom, we can talk about what's happening idiosyncratically within the crypto space, but really it's just emblematic of what we're seeing more broadly in a macroeconomic environment that is getting more and more difficult for companies across the board. And that's what you're seeing playing out in risk sentiment, not just in cryptocurrencies, but really any risk asset out there, even if we do have a semi-rebound rally taking place this morning.
Within the lines ecosystem, which we all know about. Let me do a data check here to save the show. Futures pretty much stable. The VIX pretty much stable today, 33.34. Futures off PPI, which was more quiescent than the gloom, have lifted up 6 to up 19. I'm going to call it a little bit of a lift. That's all I'm going to give you. Dow futures up 100 as well. NASDAQ moving up 0.8%. The yields, they come in a little bit, but I don't want to write home about it. 3.29% on the 2-year yield. To me, the real news, and of course, this was the announcement by the White House that the President of the United States will attend the royal family in Riyadh, and the oil price is back up to a 124 level, up $1.53 on Brent crude, 123.80. Dollar resiliency today, and of course, sterling having a tough go of it. 120.64. Maybe the president will visit with the queen on the way home. Please stay with us. An eventful day coming up. Ambassador Haas in the 12 o'clock hour. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question. That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions. Wherever you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Minutes until the open with a more constructive tone building heading into that 9:30 time from New York City for our viewers worldwide. I'm Lisa Abramowitz in for Jonathan Farrow. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
We begin with the big issue. Is this the big cathartic washout?
Maybe we need that cathartic puke.
What I would call a cathartic flush out.
That VIX over 40 to really get people to come back in.
This week is fraught with peril.
With the kind of newspaper articles you had yesterday.
The Fed is signaling 75 for Wednesday.
It's easy to react on one day's moves. We're kind of in this situation that says, you know, whatever, they're going to keep on going.
We do see 75 basis points.
We absolutely think they should hike by 75 basis points.
Whether it's the CPI or the PCE, we need to get more aggressive here.
Inflation is really the Achilles heel of risk markets.
Obviously, the market reaction has been aggressive.
Because they believe the Fed is going to be forced to get more aggressive than they had expected.
Joining us now for some perspective, Flowbank's Esty Dweck and Eric Nelson of Wells Fargo. Esty, I want to start with you as far as how you're viewing today's rebound. Is this something you want to participate in, or is it a dead count bounce?
Well, I think we've used that expression a lot in the last couple of weeks, right? You know, there aren't that many big catalysts in the coming week, especially not ahead of the Fed, that really make you want to jump in after the last couple of days sell-off. More and more people expect the 75 basis points from the Fed. They seem to manage to kind of bake in those expectations, and the market wouldn't be surprised if they get that in tomorrow. Beyond that, we really need to start to see inflation coming down a little bit faster. We knew it was going to be slow and gradual, but we're not getting inflation data for another 2 weeks almost. And that means that there's little catalyst for a real upside move, maybe beyond today.
Eric, what would you do with that then? Do you just stay out of the market, sit on your hands, and stay as conservative as you can?
Not necessarily, Lisa. I think there's certainly sectors that tend to outperform in downturns, recessions. Our equity strategy team likes a lot of the defensive plays like utilities, some of the the energy plays as well. But the real issue here, coming back to the Fed, is yes, they're probably going to go 75 basis points this week. That is our economics team's formal call now. You have to think about further out. What's the guidance? What does the dot plot look like? And our economics team now expects them to project, the median policymaker to project rates above 4% next year, so well above neutral. And so I think this is really going to continue to put downward pressure on risk overall and see more rotation toward the more defensive sectors.
Well, JP Morgan's Marko Kolanovic, who is a renowned bull for Wall Street, has been diverging from the rest of Wall Street, writing, quote, rates markets repricing went too far, and the Fed will surprise dovishly relative to what is now priced. Markets priced in more than enough recession risk. We believe a near-term recession will ultimately be avoided. SD, is that your sense right now, that basically this will be a capitulation by the Fed at a certain point when they start to see financial conditions tighten as much as they already have, and they'll pull it back?
I think at some point, I'm not sure how much they'll pull back, because once the market has sort of accepted all these rate hikes, they're going to try to get as many as they can under their belt before they might have to loosen again at some point next year. But I think at some point they are going to acknowledge that they're keeping an eye on growth. Now, at the moment, it looks like Jackson Hole is going to be pretty good timing for that. Yes, we get a lot of information tomorrow, but we really need to see a couple more months of inflation prints. And we just want to hear the Fed say, we're not blindly hiking. We're not just looking at this one factor. We have to bring inflation back down. If you look at the 10-year inflation expectations, they're holding in. They're not exactly at 2, but they're not that high either. It's that 1 year that's still quite high. And I think once they start to acknowledge growth, that will ease a lot of the concerns for markets, especially if we have the growth numbers in the U.S. stay solid, which is not too hot, but not too much weakness to stoke those recession fears either.
For now, it's not as if the data is giving them any comfort. Producer prices underscoring that inflationary pressure that's pervasive throughout the economy. This as Wall Street continues raising their Fed rate hiking forecasts ahead of tomorrow's decision. Let's bring in Bloomberg's Michael McKee for more. People looking for that 75 basis points and this PPI data not dissuading them.
The world has changed over the past 3 or 4 days, Lisa, especially starting on Friday when CPI went up more than anticipated. And really, when the University of Michigan 5-year inflation outlook came in with a big rise, a 0.3 rise in what people think is going to happen. Now, the Fed is looking at the month-over-month sequential moves in the PPI and CPI. PPI today goes up 0.8 in the month of May after 0.4 in the month of April, and that is not good news. But it's those double-digit increases that are getting the public's attention, and you can see the move in the Michigan numbers, and that's got to scare the Fed because they don't want a wage price spiral. But they still have to decide 75 or 50. The market is going with 75 now because of all the news stories out yesterday. But here's their choices. It's like a Sophie's choice. Would 75 now hurt their ongoing forward guidance? Do they have to promise another 75? Will people believe them if they do? Would 75 now help or hurt the Fed's credibility? Do people think they need to go 75? And would it backfire by suggesting recession ahead? That's going to be a key question for Jay Powell when he holds his news conference after the meeting. Now, Eric was asking about the dot plot. You can see in the dot plot what the market is expecting. The lower line there is what Fed funds futures were pricing back at the May 4th meeting. Now look above that. The white line is what Fed fund futures are pricing right now for the Fed dot plot. So we're going to see a major change probably. And as Eric pointed out, the real question is that middle dot in the 2023, where is the terminal rate? How high are they going to go? That's going to be the first thing everybody's going to be looking at tomorrow, Lisa.
Mike McKee, thank you so much. A lot of people looking for that 4% or above level. JP Morgan's Michael Feroli looking for 75 basis points at tomorrow's meeting, right? Quote, pulling off the Band-Aid a little faster. One might wonder whether the true surprise would actually be hiking 100 basis points, something we think is a non-trivial risk. The team at Goldman Sachs following suit, writing, quote, we have revised our forecast to include 75 basis point hikes in June and July. SD Dweck and Eric Delson still with us. Eric, you were talking about how it does seem like this Fed's going to have to be more aggressive, talking about a 75 basis basis point rate hike. Do you think that markets will view this favorably if they do that it actually is a positive that they're trying to get ahead a little bit of the inflation?
Well, Lisa, I think you have to consider which market we're talking about. Equities, it's hard right now to see a situation where over the next 1, 2, 3 months, the Fed will, the equity market will take a much stronger Fed tightening path as positive. I can certainly see that as maybe the worst tail risk scenario where we have 15, 20% inflation, but the Fed going much more aggressively, still a negative. I do think, though, you're thinking about maybe the fixed income market, specifically break-evens, inflation expectations. Those, have been very well behaved. The Fed being really resolute here on hawkishness should keep break-evens pretty well contained and certainly put more upward pressure on the U.S. dollar.
Well, but Eric, don't you think there's a potential liability for markets if the Fed moves 50 basis points, has a somewhat tepid signaling as far as what's going to happen, that people could get worried that they're perhaps going to get further and further behind inflation?
Yes, exactly, and that's sort of what I was saying in terms of the worst tail risk scenario where the Fed has to eventually do more down the road. So I think if they were to, after just basically signaling 75, go 50, that could end up being taken relatively negatively. At the same time, though, I still think that if they hike by 75 basis points tomorrow, signal a relatively aggressive path going forward, the equity market is, in my opinion, not going to like that. Maybe there's a very brief relief rally, but that, in my opinion, will not last very long.
Esty, what's your view on this?
Well, I think ultimately it's going to be a lot more about where we end up than whether we get that 75 tomorrow. I think given the CPI number on Friday, the 75 would be welcome. It's going to depend, again, on how much more hiking you have to expect. But I think if we start to see that terminal rate coming up higher than it's been recently, but at a level that seems to match where the market thinks it should be, it'll provide more relief than anything. And I think it'll help in a way with Fed's credibility of, catching up because maybe they've been seen as behind the curve and really getting those hikes in now that they can, because the data in the U.S. economy at the moment is allowing it to do so.
Esty, do you agree that the long-term terminal rate is somewhere around 4%, which seems to be more of the consensus in the market right now?
That feels a little bit high because we've gone up almost a whole percentage point just in the last 3 days since that CPI number. We really have a lot more data that needs to come in. But at the moment, imagining 75 basis points now and potentially 75 in July again is perfectly an option for the Fed. They've already signaled bigger rate hikes than the 25 basis points. They want to get those in. And then again, that Jackson Hole meeting starting to look more like really the better timing for any potential pivot that they would want to do, or acknowledging that growth has to be kept in mind as well.
Eric, before we move forward, as we head toward the open here, we are seeing the rally stick and actually extend 0.7% gain in the NASDAQ. At what point do you really get the sense that we've priced in what we need to price in and there starts to become value again, especially given the fact that the NASDAQ is down more than 30% so far this year?
Well, one thing in particular that really worries me, Lisa, is that there has been a continual tendency or bias to want to stand in front of this move in interest rates. This continued expectation that the Fed is going to blink, hawkishness has peaked, and it just continues to not happen. So my concern is that we continue to underestimate how much further this interest rate move can go. We tend to think that the terminal rate in this cycle will likely be close to, if not above 4. So we do expect, I know that is essentially priced in markets at this point, but in terms of the sentiment, I think something has to change here. This cycle is different than the last cycle. The Fed is much more worried, in my opinion, about inflation than it is about where the S&P 500 trades or whether or not we're at 1.5% growth versus 2% growth. Inflation is number one. So I do think there's more pain to the downside here over the next 6 to 12 months.
I think that we need to dig into what it means to have something priced in. If it's priced into one market in terms of rates expectations, but not necessarily into equity valuations. Esty Dweck, Eric Nelson, both of you are sticking with us. Joining us now with a look at the stocks moving ahead of the opening bell. Here's Abigail Doolittle.
Well, Lisa, we're certainly looking at a much easier tone on this Tuesday morning than yesterday during that sell-off with the futures higher. A big piece of it is earnings. Oracle, the shares are absolutely soaring. This on a solid beat by the software giant as cloud spending accelerates, database strength, and license upside. Now, this, of course, is an enterprise software giant, so their strength suggests that IT budgets are holding up for now. That's an important read-through. Amazon up 1.5% after yesterday in that sell-off, hitting its lowest level since April of 2020. Twitter up 2.5%. Elon Musk is going to address the Twitter staff virtually for the first time since the whole takeover talk back in April this Thursday morning. Investors seem to like that possibility. And FedEx up 8.6%. The quarter was basically in line, but the company has raised the quarterly dividend by 53% to $1.15 per share. This could even change the profile of how this stock screens. Right now, Lisa, an easier tone for stock investors.
Abigail, thank you so much. Coming up, Wall Street's latest bear market, keeping investors on edge.
We do want to kind of lean into market when we see dovish pivots coming through, but that requires central banks acknowledging the trade-off between growth and inflation.
That conversation is still ahead as we do see those gains maintained ahead of the open here, about 17 minutes until we do get a sense of whether we can break the trend that we've seen in 2 days that were ugly on Wall Street. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
The Fed says a 50 basis point hike is coming.
The Fed is telling the markets what it wants them to do.
But what's next?
Some big questions about the next move, the one after that, and ultimately the destination.
So maybe they can let the high prices naturally bring down demand.
Trust Bloomberg for the fastest coverage and exclusive analysis.
The press conference live. McKee in there. It'll be interesting.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg. The fastest way to stay one step ahead.
We see the near-term environment very challenging from the perspective of elevated inflationary pressure, but also earnings way too optimistic at this point. That is why we have lowered risk taking. But at some point, we do want to kind of lean into market when we see dovish pivots coming through. But that requires central banks acknowledging the trade-off between growth and inflation.
It's not just BlackRock. Sentiment across the board is dire. That is the takeaway from Bank of America's latest fund manager survey, showing global growth optimism falling to a record low, with stagflation fears jumping to the highest level since 2008. Let's bring in Taylor Riggs for more. Taylor.
Lisa, and sort of that really sets us up nicely when you think about some of the sort of big key themes and the big takeaways, and then what that means for some of the most crowded trades as well. This hardly will be shocking to you. It's been the theme pretty much of the year. It's been long commodities and long dollar. As we learn, king dollar, huge when you think about sort of the last few days. Long ESG is also interesting. I want to point to short treasuries, sort of the third moment there on the screen, as we've seen in the last 6 trading days before today, a 2-year yield that has been jumping about 68 basis points. That trade has certainly done well. Long cash is interesting. We know cash, even after inflation, is losing money, but that highlights the defensiveness of this nature. Long Bitcoin, maybe in the last few days, hasn't totally paid off, but really interesting when we're thinking about gauging risk sentiment in this environment. You want to talk about risk sentiment. It all comes on the back of some of those big tail risks, as you can see there. Again, hardly surprising, right? Hawkish central banks, a global recession, along with higher inflation that leads to that stagflation concern, Lisa, that you really mentioned. And then down this screen a little bit, systemic credit risk. And then, of course, the continued fallout from the Russia-Ukraine conflict. But again, with hawkish central banks really being the key focus, that is where, as you learned yesterday, 75 might be the new 50 when it comes to some of these rate hike expectations in the immediate term and the near term. 8 and 6 really is the new 4, and it is the new sort of lower end. So that really has been where the consensus has been, according to B of A.
Taylor, I like the understated that hasn't really worked out when it comes to the crypto bet.
Nice.
Taylor Riggs, thank you so much for that. Flowbank's SD Dweck writing the following: sentiment was already fragile, with investors almost looking for an excuse to sell, and the hot CPI gave it to them. Markets are caught between wanting tightening to bring down inflation and fears of what this will do for growth. SD Dweck and Eric Nelson still with us. SD, talking about what might be baked in, what will be baked in down the road. Are you actively shorting any equities? Are you still actively shorting any bonds?
No, we were a little surprised by how much sovereign bonds spiked again in the last couple of days, but it feels like we're towards the end of that cycle. Same thing with the equities bottoming. I'm a little more optimistic on the second half of the year than others, probably closer to the JP Morgan view. And that probably means that we've seen or we're closer to the highs in some of the bonds. So cautious right now, defensive right now, starting to look for opportunities to build for the medium term or even the second half of the year, little by little. But at some point, as you're saying, I think the rates market is baking in a lot of hikes already, a lot of tightening. We've seen financial conditions tighten sharply already. We have that wealth effect that's having another impact. We're going to have the mortgages have an impact on the housing market in the US. So I think a number of things are lining up for an improvement in sentiment, at least, with a little bit of a cooling in the U.S. economy and hopefully inflation coming down a bit as well.
One of the most crowded trades right now, and Eric, I want to get your sense of this. As Taylor was just outlining, is crowded dollar long, and we're seeing that even today, early in the tape. We saw a persistent bid to the dollar, despite the fact that it seemed to want to weaken as a reprieve from yesterday's strengthening. How much are you looking at that strengthening of the dollar to continue versus the euro versus perhaps some stasis where we are now?
Yeah, what's so interesting, Lisa, is that you hear the sentiment from the fund manager survey. At the same time, if you look at positioning among leveraged funds, it's really almost balanced. Whereas if you go back to 2015, we had the euro bottom around 103. It was very short, right? So I think about momentum players, some of the, those funds that tend to signal the market bottoms, they are not net short euro. So we think the euro short position and euro downside can run much further here. We do think euro will be below parity within 1 month. And to me, there is an underappreciation or underestimation of just how much euro can go below parity. This, I think, is a really important anchor in investors' minds. They're thinking that, okay, well, maybe we can get down close to that level, probably not break it because we didn't break it a couple of years ago when the Eurozone was probably in a worse position. But I think there's much more downside for euro ahead.
Eric, just real quick here, is that because of how much more the Fed's going to do than the ECB, or is it because of the existential threat created by the widening spread in Italy bonds versus German bonds?
I think it's both, Lisa. You just highlighted two of the really important points why I think investors will continue to push the euro-dollar pair lower. From a growth perspective, too, the U.S. is in a much better position than the Eurozone. The Eurozone is essentially close to stagnating at this point, whereas the U.S. is still growing at a steady clip. So, again, much more euro downside ahead, in my view.
Esty Dweck and Eric Nelson, thank you so much. Coming up later, we've got the morning calls. Wall Street anticipating more pain in stocks amid mounting margin pressures. That conversation still ahead. And we'll speak to Pete Shear of Academy Securities at the opening bell, hopefully get his take on credit in particular, given some of the incredible sell-off and the escalating sell-off, particularly investment-grade credit. When does the Fed start to take notice? Just minutes away from the open with solid green. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Building on gains, this is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. Let's take a quick look at the action. NASDAQ building on what we saw earlier, up about 1%, and S&P up 0.7%, trying to reprieve some of the losses from yesterday. If you take a look at bonds, still a bid in, although marginally so. Yields down pretty much across the board, although flat on the 30-year, 3.32% on the 2-year, 3.34% on the 10-year. Tom was talking about how flat that curve is getting across the board this morning. If you take a look over in Europe, this is what I am focused on, the existential threat to the euro, as Eric Nelson was just talking about, given how much spreads are blowing out in Italy, crossing that 4% level in Italy on the 10-year for the first time going back to 2014 on the heels of the expected tightening over there. Time now for our morning calls to look at some of the analyst recommendations on Wall Street this morning. First up, Bank of America downgrading Best Buy to neutral, $90 price target, expecting consumers to shift their spending away from discretionary products. Next up, Deutsche Bank downgrading HP Enterprise to hold, seeing limited upside given the more cautious IT spending environment. And finally, Benchmark downgrading Netflix to sell, pointing to a challenging macro environment and growing FX headwinds. Coming up, futures rebounding following 4 straight days of losses. That conversation coming up next with Pete Shear of Academy. This is Bloomberg.
At the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday. This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. Moments away from the start of trading, the rally gaining, although a little bit off where it was earlier. The Nasdaq up 0.8%. The S&P up about 0.5%, 37.72. As you see, a bid into bonds, people trying to retrace some of the losses from yesterday. You're seeing strength. Yields lower, 3.34% on the 10-year. Euro, a little bit of strength, although really fighting against the dollar strength that is coming through throughout the morning. 104.47, and crude with a little lift at 122.41. Joining us now with some stocks that are moving at the opening bell. Here is our own Abigail Doolittle.
Well, Lisa, a piece of that bullish action that you were just talking about, modestly bullish action, the S&P 500 up 0.5%, has to do with information technology and Apple. Apple, of course, the heavyweight to each of the indexes, and the shares are bouncing higher. This as yields are essentially lower to mixed, flat, but not soaring as they had been over the last couple of days. FedEx is soaring up 9.9%. The quarter was basically in line, but the company raised the quarterly dividend by more than 50% to $1.15 per share. That could actually change the profile of this company as you get some more dividend-sensitive investors in that stock. Alibaba, similar to Apple, bouncing back, up 3.4%. China Tech yesterday down sharply. And then finally, Coinbase Global reversing a big decline earlier. The largest crypto exchange is laying off 18% of its staff, citing an economic downturn. Now, we, of course, have had Bitcoin and others collapsing more recently. The question is, will that continue? The charts may point to a sharp rebound. Tune into Bloomberg Crypto at 1 p.m. We will be charting Bitcoin.
And we will be definitely watching that coming up later today. Abigail, thank you. Meanwhile, big tech bouncing back after recording its biggest 4-day slump since March 2020. Bloomberg's Ed Ludlow joining us now with more. Ed.
Yeah, good morning, Lisa. In some cases, more muted rebound, but in others, strong. Look at Oracle, for example, really an earnings story where it recorded 19% top-line growth in its cloud unit, an area that Oracle's tried to move into and forecast that could actually accelerate to growth of 25-30% in coming quarters. You look at some other names that have felt pain in recent sessions, Amazon, Tesla, Twitter, interesting, up almost 4%. Elon Musk, Bloomberg is reporting, will address staff on Thursday morning, so tune in for that. We have retraced some of the losses, but we're still feeling a lot of pain. And I'm looking very closely at the market cap that's been shed in those key mega cap tech stock names. All eyes on the Fed this Wednesday. The most bullish elements of Wall Street following the technology sector, basically hoping that the Fed is decisive and no matter what basis point increment a hike comes in, that it does something to soften yields, and that if we see a softened yield, what you see on your screen is valuations have come down, and could the time to buy be near? The other point as you look at this terminal chart is there is symmetry between what we're seeing now and what we saw in the dot-com bubble. We're not quite there yet, but the difference in the conversation I'm having with investors, Lisa, is that they say, look at the fundamentals. The fundamentals of these companies are not the same as they were in the dot-com bubble era. And there's a fantastic story on the Bloomberg terminal today titled Global Stock Rout Prompts Call for Back to Basics Investing. And there's a section in there on free cash flow. And that's one of the key areas of difference. You look at some of those tech names in the S&P 500, even software companies, the free cash flow makes them a very different name, very different strength. We're up 0.8% on the Philadelphia Semiconductor Index, for example, up 0.6% on the NASDAQ 100.
Ed Ludlow, thank you so much. The latest PPI print coming in slightly under expectations, giving sentiment a bit of a boost. Bloomberg's Taylor Riggs joining us now. Taylor.
Lisa, and you're spot on. And historically, it has given the markets a little bit of a boost when some of the numbers come in a little bit lower than expected. Maybe a relief here that inflation looks to be a little bit more under control than previously thought. The reverse has been the case when it comes in hotter, really starts to pressure the market as you continue to think about a Federal Reserve that is on the move. Coming into this print, though, inflation break-evens, at least on the 2-year, had been falling, but I don't think that this really does justice when we think about the long-term picture and the rising 2-year sort of break-evens. Long-term, that have been really, really rising, but at least coming into this, there was sort of an expectation of a little bit of a relief, and you certainly saw that, and trying to find a place here to steady out. I think what is interesting when we think about the market reaction, Gina Martin Adams has been all over this and sort of correcting and helping me understand this, Lisa, where the low beta stocks like Staples, they have done well when you think about some of the recent volatility, but you need to be careful when you think about Staples outperforming some of the discretionary stocks because they already have pretty low margins. So when we're getting hot PPI and CPI, these companies like the Staples may not be able to pass on entirely to some of the consumers here. But I guess in some of these volatile markets, that low beta play really has been the big outperformer.
Taylor, thank you so much. Fears of earnings weakness, keeping investors cautious. BlackRock's Wei Li still waiting for the bottom before she buys, writing following. We're not buying the stock dip because valuations haven't really improved. There's a risk of the Fed over tightening and profit margin pressures are mounting. Bloomberg's Kaylee Lyons joins us now for more on this gloomy picture. Kaylee.
Yeah, gloomy indeed, Lisa. Apparently a 20% decline from the record high for the S&P 500. A bear market is not yet enough to find an entry point here, at least for some of those big institutional players. BlackRock is among them, but there are others who are not willing to buy this dip, are not willing to call the bottom. Mike Wilson over at Morgan Stanley, for example, David Kostin over at Goldman Sachs in that camp as well. Mike Wilson actually taking a look at consumer sentiment and saying that drop poses a risk to the economy and the market from a demand standpoint, because if demand starts to deteriorate, if consumers aren't willing to pay up for certain goods, that limits companies' ability to pass on higher input costs through the mechanism of pricing power and higher prices for their end customer. And if that goes away, if that pricing power goes away, then margins are threatened. Over the past 3 months, we have seen operating margin forecasts falling. According to Bloomberg Intelligence, analysts forecast that 54% of companies in the S&P 500 will have lower operating margins in the second quarter than they did a year ago. And BI says that does not bode well for the market, as operating margin forecasts are usually a leading indicator of where stock prices are headed. If you look back at 2011, 2015, 2018, 2020, ahead of the market turbulence we saw in those years, you saw operating margin projections getting cut beforehand. So if history repeats itself, Lisa, that would mean more trouble is likely on its way.
Thank you so much, Kaylee. Some breaking news crossing the wires. Abigail Doolittle back with us for more. Abby. Well, Lisa, we do have natural gas futures absolutely plunging right now, on pace for the worst day since January of 28, down 17.5%. This, of course, after a headline has crossed the Bloomberg terminal that the LNG, there's been an update from the Freeport LNG update. They plan to have a partial reopening within 90 days. That, of course, means that there will be more supply. That is the Texas, the liquefied natural gas producer in Texas, of course, with the explosion last week, it had been planning on shutting its doors for at least 3 weeks, but now we're getting this update that the supply will be restarting, a partial restart in about 90 days. Natural gas absolutely plunging, down 15.3%. You can see a very dramatic plunge there, Lisa. Again, the worst since January. And just to give you some sense, Freeport LNG provides about 20% of the liquefied natural gas processing in the United States at a time when this is very much a focal point. Abby, thank you so much. We'll keep an eye on this and bring you updates throughout the day. Obviously, natural gas feeding into some of the inflationary reads and utility bills. Right now, let's turn to Peter Scheer of Academy Securities, who's been laying out the bottom line, saying, quote, I want to own treasuries here at the wide end of the range, but for the first time, I'm scared that we could break out of this range. Big problem. Credit spreads should outperform equities here, though both may be weak. Pete, I have been looking forward to speaking with you all day, since you always to say it like it is, and this was a different tone to your note. What is it that makes you more nervous now in terms of buying the dip than you were, say, on Friday when you actually did do that?
You know, one thing that I have not liked, it started really Friday and continued yesterday, is this kind of yard sale mentality, right? There's been nowhere to hide. Short-dated treasuries, long-dated treasuries, corporate bonds, equities, commodities, everything was selling off, everything was under pressure, and I'm not sure where the buyer's going to come from. So to me, that's switched, right? There's something to me that's triggered this a little bit. And on yields in particular, what we're seeing in Europe is definitely starting to scare me. You're seeing European banks underperform U.S. banks. That's never good. You're seeing Italy and Spanish bond yields, go much higher even than French and German. So this whole thing that treasuries were, the only game in town is not true either. So I'm very nervous that we could see much higher yields than I was originally expecting.
What kind of range are you looking at now?
I could see something where we get to 4% on the 10-year, and unfortunately, I don't think it would be gradual. I think it would be one of these, very abrupt sort of trading things that were happening, right? I just don't see the level of liquidity out there necessary to support the kind of, volumes that we could see.
That's where I was going to go, Pete. I was hearing about the lack of liquidity and how if you wanted to sell something, you kind of couldn't. In a lot of benchmark markets, whether it was investment-grade credit or even some treasuries, how much does this market dysfunction start to become a real problem for the Fed, where they have to address it in some capacity? I mean, this is what made them jump in March of 2020.
Yeah, it is kind of wild. If you look back at liquidity last summer when they said we still needed QE versus liquidity today, we clearly need something much more today. And you are seeing that sort of selling philosophy that you mentioned where people start selling what they can, not what they have to. So either things have gone down too much or liquidity so poor, so they move to the next asset class. And that's how you get these ripple effects. And I think that's what we saw Friday and again Saturday. So we're really caught between a rock and a hard place with the Fed where, one, they should maybe be looking at supporting the market, but they cannot because of the inflation story. And more people are talking maybe they have to hike 75 or 100 to help the market. And I get that theory, but it's still hard to believe the market would respond well to a surprise large rate hike tomorrow.
For people who lived through the past decade, it's sort of shocking to think that we're seeing investment-grade bond yields on average rise to the highest since 2009. That's where we are right now, getting up toward 5%, which was a high-yield bond yield not so long ago. And high-yield bonds you're seeing well north of 8% and on average. When does this income start to look attractive? When do you start saying, you know what, we're finally getting what we've been asking for a decade?
I think you're already seeing some of that. It's just hard to see because what I think you're seeing is some equity people selling to get into high yield, some high yield people selling to move into investment grade, and so on and so forth. So I think more and more people, though, at the end of the spectrum are getting pushed to cash. So I think you're going to see cash balances grow as people de-risk across the board, and only then will you start really seeing, real improvements. So I think there is support for investment grade, and it's coming from the equity market. But at the same time, there are people leaving this market to move to cash and safety, which unfortunately I think is probably the right trade right now.
Peter, when things move quickly, things break. At what point do we start to see margin calls and other types of triggers escalate selling?
I think we're seeing that already. I think yesterday what we saw is a lot of pressure on crypto, right? That went down. And that very quickly feeds into the disruptive stocks, which feeds into the major tech indices, which feeds into individual companies. So I'm watching the tech market very closely, the crypto market very closely. I think we could see Bitcoin down 15,000, maybe 10,000. To me, two big things are really occurring there is you're seeing with these layoffs that you just mentioned on coin, that they're not seeing the adoption or the use case grow. That was always an important thing, right? This FOMO, getting new people into the asset class. And at some point, I've got to believe there are some long-term holders who have been down money for the last 2 years who might think about locking in some serious wealth, right? Crypto traded in $8,000 to $9,000 for most of 2018, 19, and 20. They still have some gains. I think you take that and see where this plays out. So I do not believe we're going to see a crypto bounce. In fact, I think we're going to see weakness. And what we're just starting to get a handle on is how important has crypto wealth been to this economy, both on the spending, but also on the hiring, the conferences, the semiconductor purchases, and also the energy usage. So I think we could have a really rough summer.
And just to sort of build on what you were saying about Coinbase, earlier the news broke that they're laying off about 18% of their workers because, as you said, Peter, the adoption just isn't there. You point to the systemic aspect of crypto. Do you think that it is bigger than people appreciate? And could it have potentially, I don't want to say a disinflationary kind of shift, but could it actually accelerate the shift to something that perhaps is more comfortable?
Yeah, I actually think first we're going to see more economic problems because you're going to see less spending. You're going to see some of these things. But ultimately, I think it will ease some of the pressure, especially on the energy, right? There's been times that crypto mining has accounted, would have been like the 10th largest economy in the world in terms of its energy usage. Yes, they're able to harness some energy that couldn't go otherwise, but some part of that's coming out of the grid. So we might actually see a reduction in energy prices if crypto kind of really falls out of bed.
Pete
and becomes far less popular.
You're sticking with us, and we've got a lot more to talk about. Coming up, President Biden visiting Saudi Arabia in July.
Of course, he will be. They will discuss energy with the Saudi government. I think what I'm trying to say is to look at this trip as it being only about oil is not. It would be simply wrong to do that.
That conversation coming up, and we are about 13 minutes into the trading session with gains across the board, people trying to maintain something that does seem to be fading, however. The S&P up now less than 5 basis points. This is Bloomberg.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done, uses a small sample number, and most of the time, when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We continue to plan for a trip to Israel and Saudi Arabia. This would be an opportunity for the president to engage with leaders from across the Middle East region. Of course, they will discuss energy with the Saudi government. I think what I'm trying to say is to look at this trip as it being only about oil it would be simply wrong to do that.
We'll get to the political response to inflation in just a moment. Just wanted to point out that stocks are really fluctuating between gains and losses, had been actually in the red across the board, now regaining some of that, but highlighting how fragile this market move is and how little conviction there is behind the bid to buy. President Biden heading to Saudi Arabia amid record gas prices. Bloomberg reporting that Biden will visit in July and meet with Crown Prince Mohammed bin Salman. Bloomberg's Anne-Marie Hordern joining us now for more from Washington, D.C. Anne-Marie, what are they hoping to accomplish?
Well, it's going to be wide-ranging, and I think the administration, everyone jumps, of course, to oil, given Saudi Arabia is the central bank, you can say, of oil. They've been a swing producer for decades, and you do have the biggest domestic problem being inflation, higher gasoline prices now north of $5 a barrel and a gallon on average across the country. But they are making sure to point out that this is not just about oil, and they did so in a number of statements. We also heard from the Saudi Arabia's embassy talking about the fact that this will be about other global challenges, economic investment. They name a number of issues, Lisa, like space, energy, cybersecurity, climate, food security as well. The one thing I would point out, though, the White House statement that came out did not mention Crown Prince Mohammed bin Salman, but the embassy statement did, and that statement said the Crown Prince and President Biden will hold official talks. So the two would not just be meeting, they will also be holding official talks, meet with other members of the GCC. So politically, you can see that this one is tricky for the White House. A president that said he wanted to make the kingdom a pariah and has said that at one point there was nothing worthy of this country. He will now go and visit it, which kind of ends the pariah era and is a bit of a restart for this administration with Riyadh.
Anne-Marie, thank you so much. Peter Scheer is still with us and taking a look at gasoline prices, well above $5 a gallon when you look across the average of American gas stations. How much are you looking at this to be the swing factor in terms of a recession or a soft landing?
One thing I've been very disappointed in, I thought our response to what's going on with the war in Ukraine would be to address some of our own problems, right? We've underinvested in the industry. We haven't made it very comfortable for our energy companies. We killed the Keystone deal. I thought we'd see a much more, aggressive attitude towards returning to complete energy independence here, making sure we are built. And I don't like kind of the fact that we seem to be almost going hand in hand, asking for handouts and favors and sending very mixed messages. I would think the Saudis are aligning themselves closely with China. When we shut down Russia's access to dollars, I think every autocratic nation across the globe, especially the commodity-producing ones, turn to China. So we're going to have to address these solutions ourselves. We're going to have to figure out what we can do domestically and with our closer allies. And I'm not seeing that being done. And that's one reason I'm very nervous about gas prices coming into this. And then what I'm hearing is refineries that can do it, it's mostly outside of the US, are starting to switch to diesel production because they can make so much money in diesel right now, that you're going to see ongoing pressures in the gasoline. And that's just hurting the economy. It's hurting individuals at all levels.
And it's also affecting earnings margins. And we're seeing that, profit margins, I should say. We're seeing that in terms of the expectations that companies are putting out there, as well as what they are telling us, whether it's Target, and they're boosting their dividend in response to it, or many other companies. How much do you think we've adequately priced in the margin pressures from these higher oil prices, from the higher salaries, and the like?
I think we're just starting to do that. When we look at it, a lot of people seem to be talking about, well, we might get a recession if we don't get a soft landing, but that recession's, next year type thing. I think there's a real chance that this economy kind of hits the brakes as early as this summer. So we've got to be addressing this sooner. And I don't think we have the urgency that's necessary to get this going. Whether we cut taxes or something, we've got to drive the economy, and it's just not occurring.
And bank CEOs have been increasingly pessimistic, with the exception of Bank of America. Morgan Stanley's James Gorman coming out seeing a 50-50 recession odds, saying, quote, unlikely at this stage to go into a deep or long recession. It's possible we go into recession, obviously, probably 50-50 odds now, but that's okay. We also heard from Goldman's former CEO, Lloyd Blankfein, seeing too much pessimism, talking about dialing back the negativity. If I'm managing a big company, of course I'm prepping for the worst, but come on, guys, we could potentially get a soft landing. Where do you fall on this?
I really don't see a soft landing right now. I think we pulled, we don't talk enough. We only talk mostly about the rate hikes, but we have QT going on, right? So the Fed's reducing their balance sheet. All indications to me are that Fed balance sheet expansion helps risk assets, and I can't see any reason that Fed balance sheet reduction doesn't hurt risk assets. So we're facing that on top of everything else. I think, unfortunately, there's a likelihood, and we could be kind of coming into an ugly economic scenario by the election.
Peter Scheer.
And we've been talking.
I hope you're wrong, but I know that you're not alone in that expectation. Peter Scheer, thank you so much for being with us. We really appreciate it, and all of your insights. Coming up, the market-moving events that you need to be watching. That's next in our trading diary. A real messy tape right now, fluctuating between gains and losses. Now losses on the NASDAQ down 0.1%, the S&P up 0.1%. Yields still getting a little bit of pressure, bonds getting a bid as we head toward the rest of the day. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Trying to recover. This is Bloomberg's The Open. I'm Lisa Abramowitz in for Jonathan Farrow. A quick look at the gains that we are seeing. It's been fluctuating between gains and losses. Now up 0.4% in the Nasdaq, around the same amount on the S&P. If you take a look, there still is a bid into bonds. Perhaps that's what's supporting this, because perhaps we get some sort of near-term cap to yields. You can see the 10-year yield at 3.35%. That 2-year yield very close to it. That flattening in the yield curve, 3.3175%. I'm most focused right now actually on the European markets. Those 10-year Italian yields still near the highest levels going back to 2014. You can see the German yield also near the highs that they've seen since the pandemic. And this is what's putting pressure on the euro, although not today. We're seeing a bit of a reversal in that. Time now for the trading diary. What you need to be watching this week: President Biden discussing the economy at 11 Eastern. Then retail sales out on Wednesday, followed by a trifecta of central bank rate decisions. First up, the Fed, Chair Powell's news conference on Wednesday, the Bank of England on Thursday, and finally wrapping up the week with the Bank of Japan on Friday to address that yield curve peg. This was Countdown to the Open from New York. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their $1 million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance, they say, is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fiero's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complications due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off. Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Benegold as an opportunity to leave that troubled home. Benegold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Benegold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Benegold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Wiener Gold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.